We're reading this 8 days. This is written 2009, once the bailouts happened. So this is an in-depth report of the major players in the financial crisis. Of course, yesterday when we explored the first 4 pages, we learned that Hank Paulson, this guy, Bernanke, and Geithner, all three of these people actually wrote books on this. So we might, I can't promise we will, but we might read some of their stuff. So anyways, let's start. And once I read through this section, if I can read through it without going on tangents that are better explain what we're reading, then I will read your comments. So, Christopher Flowers, the billionaire founder of the private equity firm J.C. Flowers and Company. Oh, by the way, before we begin, where we left off yesterday, we weren't sure if Lehman Brothers was going to get bailed out, right? The Fed was talking to both Barclays and Bank of America, and basically there was a potential plan that the really bad liabilities that Lehman Brothers had, for at a 30-to-1 ratio, by the way, bad stuff to good stuff, the U.S. government would foot the bill and then it would be acquired. But I don't know if that's fair to anyone, right? So we're talking about Christopher Flowers, self-described low-life grave dancer with an eye for failing banks, found himself Zelig-like in the midst of the week's dealings. Slender, bespectacled, and rumpled, Flowers was a math wizard who liked chess. Hey, I like chess too. And those skills made him a formidable opponent in the intricate moves of financial takeovers. In some cases as an advisor to firms doing deals, in others as an actual investor. Flowers knew Paulson well, having spent 20 years at Goldman Sachs and had worked with Bank of America officials in the merger with National Bank. He talked regularly to Maurice Greenberg, the former chief executive of the Giants insurance conglomerate AIG. We're going to have a lot more about AIG soon. And did business with others in the insurance industry, especially executives at Germany's Alliance. People on top, they all know each other, right? I don't think, some people would say, oh my God, they control everything. They know them. They don't get along. When you have that much power, there's a lot of power play, right? So it's not that the people on top control everything, but they do know each other. That's for certain. Earlier in the week, a Bank of America official told Flowers that the firm was considering buying Lehman and said that it wanted him as a partner in the deal. Ooh, Flowers and a Bank of America team had spent the previous 24 hours at a Midtown law office going over Lehman's books. Its finances turned out to be far worse than Flowers expected. The exposure to risky residential mortgages was widely known, but not the firm's $32 billion portfolio of commercial real estate assets, much of it of dubious quality. By the way, currently, there is a lot of sketchiness going on in the commercial real estate again, right? So we're kind of repeating some of it, but yeah, commercial real estate is still very sketchy. The then an AIG executive asked him to join a meeting at AIG's headquarters in Lower Manhattan. What's the problem, Flowers asked. AIG, it turned out, was facing a liquidity crisis, the result of disastrous bets made by its financial products division, based in London. AIG Financial Products had become one of the largest issuers of credit default swaps, a product similar to insurance. The buyer pays the company in return for a promise of reimbursement in the event of a default on a bond or other debt security. If the likelihood of default increased, AIG had to post collateral with its swaps buyers or counterparties to guarantee eventual payments. If any of that sounded confusing, it is. Because if it weren't confusing, we wouldn't be in this mess anyways, right? So don't worry if you don't get what a credit default swap is. Nobody does. I believe credit default swaps was invented by someone in his 20s, man. Like a smart dude in his 20s. Again, the nature of things, right? AIG had been a pioneer in credit default swaps barely 10 years earlier, and since then had amassed hundreds of billions of dollars in exposure. The risk to AIG from the huge portfolio had seemed minimal, since the likelihood of a default in any given transaction was low. As a result, AIG hadn't hedged its own exposure to its swap portfolio and was earning enormous profits on the business. But during the summer of 2008, as an increasing number of borrowers became unable to pay their mortgages, default rates rose. The U.S. ratings agency began to wholesale downgrade of mortgage-backed securities, triggering demands that AIG provide ever larger amounts of collateral to buyers of its swaps. It wasn't clear how AIG could come up with the cash. When Flowers and a group of his firms arrived, dozens of investment bankers, private equity investors, and AIG officials were meeting in various conference rooms. Flowers and his team were given their own conference room where they and some AIG finance officers examined a spreadsheet tracking the parent company's cash flow and liquidity. The cash flow projection showed AIG to be in dire need of capital. It was facing a $6 billion cash shortfall by the following Wednesday. $6 billion cash shortfall. A figure that would rise to $25 billion the next week and $39 billion the week after that. Whoa. Flowers looked up from the figures. Bankruptcy, he said. Wait a minute, one of the AIG finance officers replied. Let's don't be alarmist, he said. Let's don't be alarmist. Wow. Maybe I gotta put on my thicker glasses now to. It's about to get interesting, right? It's about to get cringe. So maybe to prepare for the cringe, we gotta put on these glasses, the cringe glasses. All I know is, if you don't pay $6 billion next week, you're gonna have some very unhappy people. Flowers replied. Robert Williamstad, AIG's chief executive, walked in as the group was eating sandwiches. Williamstad, a reserved old-school banker and 20-year Citigroup executive who lost a succession struggle, had always wanted to run a large public company. He got his chance in June. Oh, wow. This guy was pretty new. The chief executive of AIG was pretty new to AIG when all this was happening. At its peak, the world's largest insurance company ousted the chief executive, or the company's chief. Williamstead, who had been the board chairman, had formulated an ambitious restructuring and turnaround plan and was just beginning to implement it. But the deterioration in the financial products division and the mounting collateral demands were sources of growing concern. Williamstead had hired J.P. Morgan to advise AIG and help it raise capital. Dude, all these companies, they're all like... Dude, they all know each other. They're all in cahoots. It's kind of funny. That morning, Williamstead had called Timothy Geithner, the guy at the New York Fed, concerned that the ratings agencies were going to downgrade AIG, perhaps as soon as Monday. Depending on the severity of the downgrade, it would prompt more collateral calls of anywhere from $13 billion to $18 billion. AIG's cash crisis was potentially catastrophic. Williamstead told Geithner that he needed to raise $20 billion. AIG, an insurance company, was even farther than the Fed's mandate than Lehman Brothers. Geithner stressed that AIG needs to find a private sector solution, but he agreed to send some Fed officials over to assess the situation. Flowers and Williamstead also called Jamie Dimon, the CEO of J.P. Morgan. Dimon, I guess, was even more forceful. As one participant recalls, his message was, stop PUSSY footing around. Get real, get serious. This is urgent. Call Warren Buffett, Flowers told Williamstead, and gave him the number of Buffett's private phone. Don't even wait 1 second. Buffett answered, and Williamstead described the liquidity crisis. Buffett asked some questions and later said he needed more time. Later, he called back to say that he might be interested in some of AIG's businesses if they were for sale, but he didn't want to get involved with the parent company. Always reluctant to invest in companies whose operations he didn't thoroughly understand, Buffett said that AIG was too complicated. When Warren Buffett says that some of this stuff is too complicated, Buffett did not respond to requests for comment. Yeah, when Warren Buffett says all this stuff is too complicated, you know cringe is about to happen, right? So we finished reading a section without me interjecting. Hey, how do we like that? Let's see if we get any comments right now. Again, I hope we get some good conversation from this. So let's look at the live chats real quickly. For those of you tuning in, I'm going to finish this article, man. This is a leftover article from my days in college studying macroeconomics. I knew that I was going to have more fun with this later on in life as I learned more about life, learned more about everything in this world, right? I'd have a new opinion, new understanding of this. So, anyways, they were talking about potentially saving Lehman Brothers, to summarize what we just read. But now it turns out AIG's even worse, man. AIG was anywhere from 6 billion to 25 billion to 39 billion. And then if its ratings got downgraded, right, the 6 billion would turn into 13 billion. I don't know what the ratio is, what the 25 billion would have turned into, but it would have been bad. It would have been bad. So AIG, an even bigger entity, is getting on the verge of bankruptcy, right? And they called Warren Buffett, and Warren Buffett's like, this is too complicated for me. I don't want to do anything with this. That afternoon, Fed staff members called a number of Wall Street CEOs and asked them to attend an emergency meeting. Among the CEOs were Jamie Dimon, Vikram Pandit of Citigroup, Brady Dugan of Credit Suisse Group, John Thain of Merrill Lynch, John Mack of Morgan Stanley, and Lloyd Blankfein, Paulson's successor of Goldman Sachs. Again, Henry Paulson, the Treasury Secretary, was the CEO of Goldman Sachs. As one veteran, the long-term capital management rescue remarked, that kind of call is never good news. At 6 p.m., a line of Blacktown cars of SUVs, this was the time of SUVs, right, made their way along Maiden Lane in Lower Manhattan and entered the garage of the New York Federal Reserve Bank, a 17-story Italian Renaissance-style fortress. Underground in the bank's vault is the largest stockpile of monetary gold in the world. Huh. I thought Fort Knox is where they kept all the gold. So now we learned something new. Apparently, under the New York Fed's bank vault is the largest stockpile of gold. The New York Fed implements the monetary policy set by the Federal Reserve Board in Washington and oversees the banks of the nation's financial capital. Timothy Geithner had become the president of the New York Fed after a long career in the Treasury Department. Dude, it's all revolving, right? On the recommendation of two former Treasury secretaries, Lawrence Summers and Robert Rubin. By the way, talking about Lawrence Summers. So Lawrence Summers was the Treasury Secretary under Clinton, right? I went to school with Lawrence Summers' two daughters. I didn't even know that they were. One time they mentioned that some of the bills were signed by their dad, but I was so young. Again, I was middle school, right? I didn't know that they were talking about Lawrence Summers. And as you know, Lawrence Summers later on was at Harvard, right? He was the president of Harvard for a while. And our favorite buddy Zuckerberg, part of the reason Zuckerberg got to steal all that stuff from the Winklevi, I wouldn't say that Summers helped him, but Summers, I think, wasn't on the Winklevi side, I guess is the better way of describing it. But yeah, small world, huh? It's funny that I went to middle school with Lawrence Summers' daughter. Anyways, although he had who? We're talking about Timothy Geithner. Timothy Geithner, the chairman of the New York Fed. Although he had degrees in Asian studies from Dartmouth, Timothy Geithner was an Asian studies major and a graduate degree in East Asian Studies and International Economics from Johns Hopkins School of Advanced International Studies. Geithner lacked a PhD and an MBA. He also lacked experience on Wall Street and in banking. He was 47 but looked much younger, and some felt that he lacked the gravitas to be a Fed president. But he seemed to have no trouble holding his own in discussions with Summer and Bernanke, sometimes punctuating his remarks with profanity, and thereby injecting some blunt common sense into the debates. That's so funny. The chairman of the New York Fed was an East Asian Studies, and then undergrad he was an Asian Studies major. That's pretty funny. I showed you guys this yesterday, but if you want to see, just to kind of get a context about the Federal Reserve. So the Federal Reserve, for those of you who are unfamiliar, the Federal Reserve is basically let me figure out how to best, maybe this is best. I don't know if you guys can see this, but the central bank, and it's got different branches, right? The New York Fed, this is Timothy Geithner right here, right? Currently, the president is John C. Williams, but the New York Fed tends to be very powerful. Of course, the Federal Reserve, the is over here, right? And then the St. Louis Fed right here is pretty powerful. St. Louis Fed, he is the Alberto Mussolini. So usually when you hear about the Fed, you hear about the main place in DC, and then you hear about the New York Fed, and then you hear about the St. Louis Fed. Like, I lived in Philly, and I never knew there was a Philadelphia Fed, but yeah, 12. There's 12 districts in the in the Federal Reserve. So just something for you guys to keep in mind. So when we're talking about Timothy Geithner, we're talking about the New York Fed right here. All right. A number of the CEOs brought their chief financial officers to the meeting. Several European banks, including Deutsche Bank, Royal Bank of Scotland, and BNP Paribas, sent their ranking officers who were in New York. The meeting took place in a conference room off the building's lobby. Paulson was there too, and he and Geithner sat at a large rectangular table surrounded by other government officials. The chairman of the SEC, Christopher Cox, was also present. Cox, a former Republican congressman who had represented Orange County, Florida, for 17 years, was on hand as a regulator, since Lehman and other investment banks are subject to SEC oversight. Hey, small world. I might be in Orange County in November. Anyone that's in Orange County, let me know. Geithner thanked the bankers for coming on a short notice. I just realized the mic was kind of far from my face. Short notice. Then turned the meeting over to Paulson, the Treasury Secretary, who said that despite the rescues of Bear Stearns and Fannie and Freddie, there would be no government money for Lehman Brothers. Fortunately, there were two potential saviors. Paulson didn't name them, but everyone present assumed that they were Barclays and Bank of America, both conspicuously absent from the meeting. Hey! Still, there was likely to be a pool of Lehman assets that some buyers would not take. It would be up to the CEOs in the room to finance that pool. Why would you, as the CEOs, want to save a competitor, right? Paulson now acknowledges, as some in the room suspected, that the government was more amenable to funding a rescue than it let on. We said, no public money, he told me. We said, this publicity, we said this publicly. We repeated it when these guys came in. But to ourselves, we said, if there's a chance to put in public money and avert a disaster, we're open to it. Speaking for the Federal Reserve, Geithner noted that Lehman's trouble had been highly visible and that investors had had weeks, if not months, to prepare for its demise. Even so, he said, a Lehman failure would be catastrophic and it would likely be impossible to contain the damage entirely. Cox told the CEOs he realized that they were usually competitors. Exactly, this is what I was thinking. However, he said, their collective well-being turned on a well-functioning market, and the purpose of the meeting was to restore that market. Dude, I would not save them if they were my competitors. Like, what are they thinking? Hilarious. Lehman wasn't the only vulnerable investment bank, even if it found a buyer who would be the next to face a run and possibly ruin. Paulson reminded the CEOs that Lehman was unlikely to open for business on Monday morning, so they had just 48 hours to resolve the crisis. Wow. Geithner divided the CEOs into three working groups. The first, led by Goldman Sachs and Credit Suisse, was asked to value Lehman's troubled assets and assess the amount that the firms would have to finance. The second, which included Merrill Lynch, Citigroup, and Morgan Stanley, was told to consider various structures under which Lehman could be sold and its bad assets recapitalized. The third was to prepare for a Lehman bankruptcy. The meeting ended at about 9:30, and the working groups agreed to reconvene the next morning. So when did they start meeting? When they start meeting? I guess in the morning, right? Oh, 6 p.m. 6 p.m. So they worked for 3.5 hours, and then they agreed the next day to work 3.5 hours. Can you really figure anything out? Right? They started at 6 p.m. and then they ended at 9:30. All right. Before I go to the next section, let's check if anyone wants to say anything in the live stream. Okay, nobody in the live stream. What happened to all the Economist viewers that have been talking in the last video? That's okay. Anyways, here we go. At 8 a.m. the next day, September 13th. So, there we go. The Wall Street CEOs dressed in slacks and sports shirts reassembled in the Fed conference room, some carrying coffee and crumb cake. Paulson and Geithner said that Barclays was the most likely buyer for Lehman, but that the negotiations with Bank of America were continuing. In either case, there had to be a private solution for the toxic assets. The chief executives were unsure how expensive that solution would be. And why would Wall Street firms finance a transaction to benefit a competitor like Barclays? Yes, exactly. So it wasn't just saving Lehman's, right? To save Lehman's, you would help out either Bank of America or Barclays, which was a competitor of all the people that were on hand, Goldman Sachs, Credit Suisse, Merrill Lynch, Citigroup, Morgan Stanley, et cetera, et cetera. Right? They don't. Why do they want to help Lehman Brothers? And then if they help Lehman Brothers, they're going to help Barclays, right? Or they're going to help Bank of America. See, it's like, I don't know what these people are thinking. As in the people in the government, I don't know what they were thinking. Demon, aka the CEO of JP Morgan, Demon spoke up. Look, we're all in a fix. This is something we have to do in the best interest of the global financial system. Geithner again broke the group into teams, saying that they would reconvene in several hours. When they did, the bankers reported that they were thinking about establishing a revolving line of credit to support other banks that might find themselves in Lehman's predicament. But Geithner had asked them to focus on Lehman. You guys have got to try harder, he insisted. Throughout the day, when members of various groups passed in the Fed quarters, they asked one another, are you trying harder? Oh my God. John Thain of Merrill Lynch worried, like the others, that a resolution of the Lehman crisis would just shift the crisis to the next vulnerable bank, which might be Merrill, aka Merrill Lynch. Thain, who was 54, grew up in Antioch, Illinois, and first came to prominence at Goldman Sachs, where he advanced rapidly. He has a trim, square-jawed, with thick hair and brown eyes and a resemblance to Clark Kent. He studied engineering at MIT and received an MBA from Harvard. He had been a co-head of Goldman's complex mortgage operations before being named chief operating officer by Paulson. He left to become chief executive of the troubled New York Stock Exchange, successfully took it public, and gained a reputation as a turnaround expert. Merrill Lynch was also in trouble when it approached Thain in 2007. It had just fired Stanley O'Neill, who, as chief executive, had made Merrill one of the largest underwriters of mortgage-backed securities. Oof. A strategy that proved disastrous when the housing bubble burst. Merrill's board offered Thain a $15 million signing bonus. He had assumed the position in December of 2007, just as the subprime crisis was eroding the firm's balance sheet. Oh no. So what we see is a lot of these execs were pretty new when this happened. It's pretty funny. They were basically jumping on a sinking ship already. Thain immediately shook up Merrill's hidebound culture by recruiting two of his former colleagues from Goldman with lavish guarantees. Thomas Montag as the head of global sales and trading with a reported pay package of $39.4 million. Wow. And Peter Krause as the head of global strategy with a $29.4 million contract. Each man also received millions in Merrill stock to replace his Goldman holdings. Thain hired the Los Angeles decorator Michael Smith to renovate his office and adjoining conference rooms at a cost of more than $1 million. Jeez. People with wealth just live in a different world, right? Again, I'm not hating. I don't think anyone would deny that, right, if you were given the opportunity. It wasn't Thain's pay or his spending, though, that annoyed Merrill's rank and file. It was his and his former Goldman colleagues' superior manner. He made a point of making it clear that Merrill people were inferior to Goldman people. A former Merrill executive said he was disappointed in the quality of the infrastructure and the people at Merrill Lynch. Of course, He had good reason to be. They were in the process of losing tens of billions of dollars. Thane disputes this characterization. The highest ranking Merrill official to survive the transition was Gregory Fleming, who some at Merrill had thought would succeed O'Neill. Wanting to maintain some continuity, Thane kept him on as president. Earlier that morning, Fleming had called Thane at home in Westchester County. For weeks, Fleming had wanted to prepare various contingency schemes for Merrill. The best hope for a possible rescuer was Bank of America, which had twice tried to get Merrill into merger talks but had been rebuffed. Now that Bank of America was renegotiating to buy Lehman, Fleming was even more insistent. It's time to call Ken Lewis, he said. In Thane's view, Merrill just needed time for the market to stabilize in order to generate more earnings. He thought that Fleming sounded hysterical and suspected that Fleming's sudden eagerness to sell the company reflected, at least in part, resentment in having been passed over in favor of an outsider. Fleming, for his part, suspected that Thane was resisting his suggestion in order to protect his job as chief executive. You know how in history they talk about, is it individuals shaping the flow of history? Does history sort of flow whether the individuals have a say in it or not, right? And you do realize reading this that it's just a few people on top. What they do really matters, man. Some people call it the great man view of history or whatever, but you can see it kind of here. So many decisions were made by just a few people up top. So we just finished another section. Wow, we're making a lot of progress here. Youssef is here. What's up, Youssef? Youssef joined us for our first little exploration. So Youssef, welcome to part 3, man. I left my water somewhere. I'll be right back. I left my water. So I will get some water, and I will be right back. Let's see. Cool. All right, guys, I got my water. All right, let's go. We're going to finish this, man. We're going to finish this. If we don't finish it today, we're going to finish it tomorrow. I'm going to finish this. Later that day, Lehman officials went with the team led by Goldman and Credit Suisse, which was trying to quantify the hole in Lehman's balance sheet. The amount by which liabilities exceeded assets. The Lehman people discussed the problems on the balance sheet, the quality of their assets, the specifics of the liquidity crisis, including a $5 billion collateral call that week from JP Morgan Chase, Lehman's clearing bank. Afterward, the Goldman and Credit Suisse team told the CEOs that the hole appeared to amount to tens of billions of dollars. So not $5 billion, but tens of billions of dollars. Lehman's commercial real estate assets in particular were being carried on the firm's books at a far higher value than was realistic. As one participant put it, the air kind of went out of the room. Thane was particularly unnerved. JP Morgan was Merrill's clearing bank too. In the building's lobby after the meeting, Thane discussed the developments with Peter Krause, one of the Goldman bankers he had hired, and Peter Kelly, Merrill's general counsel for operating businesses. I think they're really going to let Lehman go under, he said, reconsidering his early rebuff of Fleming. Thane stepped outside the building and called Ken Lewis at home in North Carolina and told him, I think we should discuss some strategic options. Lewis immediately flew to New York and a few hours later answered the door when Thane arrived at Bank of America's corporate apartment in the Time Warner Center. The two men were alone. We're invested in having Bank of America buy a 9.9% stake and put at our disposal a multi-billion-dollar credit facility. Thane said. I'm not interested in a 9.9% stake, Lewis said. Well, I didn't come here to sell the company, Thane replied. That's what I'm interested in, Lewis said. Lewis pointed out that Bank of America, despite its size, wasn't much of a force on Wall Street. In Merrill, the company would get a global presence in investment banking, the best brand name in wealth management, and Merrill's vaulted army of retail brokers. Thane, among others on Wall Street, felt that Lewis and other Bank of America executives in the South had a chip on their shoulder, imagining that they were never accorded the deference shown to J.P. Morgan Chase or a Citigroup. Thane suggested that they assemble teams to pursue both options, the 9.9% stake and the takeover. Lewis replied that maybe they shouldn't tell anyone else about a potential deal. I've got to tell Hank Paulson, Thane said. He was worried that he would be blamed for deflecting Bank of America's interest away from Lehman. We're not going to pursue Lehman Brothers, Lewis said, but go ahead, you go tell Paulson. When Thane got to the Fed, he found Paulson and told him that he met with Lewis. Good, Paulson said. In the conference room, the discussion grew tense as some pointed out that it wouldn't help to save Lehman if the crisis just spread to the next bank. As J.P. Morgan's Jamie Dimon and Morgan Stanley's John Mack put it, a firewall was needed to stop the fire spread, and that firewall would have to be Merrill Lynch. As the gathering broke up, Mack pulled Thane aside and proposed that they meet that evening. At about the same time, Gary Cohn, Goldman's president, told Peter Krause that Goldman might be interested in buying a stake in Merrill. Krause and Kelly agreed to Goldman's headquarters early next day. So last time, when we were reading the beginning of this yesterday, Timothy Geithner, Ben Bernanke, and Hank Paulson wrote books reflecting on this. I wonder if these CEOs of all these Wall Street firms wrote. We should look it up next. Let me search, and then if I find anything, I will. Oh yeah, Caramel Dream says Goldman Sachs should be delisted and investigated. Heck yeah. So Caramel Dreams, thank you for tuning in again. I'm so glad I got an economist viewer tuning in. I'm gonna look up to see who besides the people in the government wrote something about this. So let's look at Jamie Dimon. Let's see if he wrote any books. So Jamie Dimon is still, I believe he's still at, let's see, where is he? I'm gonna have to log into LinkedIn. I don't want to log into LinkedIn. But it looks like he's still at J.P. Morgan and Chase. Let's see. So he's still there. Jamie Dimon book. Let's see if he wrote any books. Let's see. Not really. I mean, there's a book written about him, but there's no. Let's look at some other people mentioned in this. Did Peter Krause ever write a book on this? Because it'd be kind of cool to hear what the private sector was thinking about this, right? I don't think we're going to find any books written by these Wall Street execs. They're too busy making money. They don't care. They don't want to tell us anything about the financial crisis. John Thane. Let's see if John Thane wrote anything. Nope. I mean, it looks like John Thane might have wrote a investment book. But yeah, he didn't, I don't think he wrote anything that on the, yeah, he didn't write anything on the financial crisis. Let's look at maybe a few more people. I don't think it's worth it even to look. I don't think any of these execs are going to write books. They don't care. Okay. So where we just left off, it looks like Goldman Sachs might be interested in buying a stake in Merrill Lynch too, right? Because Merrill Lynch is about to go under. So now we have Lehman Brothers about to go under, we have Merrill Lynch about to go under, and AIG about to go under. It's not looking good, man. And the rest of the CEOs are just kind of here, just sort of like pretending they want to save anyone, but really they're like, it's better for us if all these other firms fail. Guys, that's just my interpretation. You know, you could interpret it whatever way. Paulson and Geithner had spoken on the phone that morning with the Barclays team, including the firm's president, Bob Diamond, at Barclays New York headquarters. Barclays CEO John Verley was on the line in London. So Barclays is talking about potentially acquiring Lehman Brothers. As Paulson and Geithner listened at the New York Fed, their staff members gathered around. The previous day, Paulson had talked with his British counterpart, Alistair Darling. His last name is Darling, the Chancellor of the Exchequer, to make sure the British authorities were comfortable with Barclays' involvement in a potential Lehman rescue. Darling had pointed out that authority over Barclays' deal rested with Britain's Financial Services Authority and the Bank of England, and the British regulators would be asked tough questions about the risks for the British taxpayer. In other words, probably even if Barclays was serious about this, the UK wouldn't have allowed this. That's what I'm reading between the lines? Yeah, between the lines. That's the expression. Paulson turned to two of his Treasury aides who were in his office during the conversation. He doesn't want to import the American disease, Paulson said. Now Diamond spoke for the British. Barclays was prepared to make an offer for Lehman, he said, with several conditions. The plan provided an elegant solution to Lehman's troubled assets. They would remain in a Lehman entity, which would be dubbed Newco and owned by Lehman shareholders. Barclays would buy everything else. The proposal would leave a shortfall that Barclays estimated at 15 or 16 billion, for which funding would have to be found. So basically, Barclays says that either other firms in America make up for that 15 to 16 billion, or the US government, right? The Fed or someone does this. Barclays knew that on Monday morning, someone would have to guarantee Lehman's debts until the deal closed, as JP Morgan had done for Bear Stearns. If someone did so and investors had confidence in the guarantee, business would continue as usual. Otherwise, customers would flee. Although the sums at stake would be large, the risk was relatively low. British regulations required a shareholder vote to approve such a guarantee. Since Barclays would need to secure a guarantee for Lehman's operations for as long as a month before a deal could be closed, the Barclays people called Warren Buffett. Buffett was amenable, up to a point. I could take a look at providing maybe $5 billion of protection, he said, but he wouldn't commit to more. So you would still have 10 to 11 billion that someone else had to put up. After the call, the Barclays bankers and advisors decided that it was pointless to pursue the matter. If the bank had to announce a piecemeal guarantee in which Barclays honored 3 billion, Buffett 5 billion, and so on, investors wouldn't be reassured. No private entity would assume an unlimited exposure, no matter how slight the risk. Only a government could do that. Could a government do that, right? You should probably say only a government could do that on the short term. You don't want to make a blanket statement like a government can do that. A government can take on an unlimited risk. So I don't agree with that sentence. Perhaps the Treasury or the Fed could simply say that it was backing Lehman's obligations until the deal closed or until shareholders approved. The Barclays bankers were convinced that such a guarantee wouldn't cost U.S. taxpayers anything. Take a little break, guys, while we process what's going on. Sandman IS wrote Yanis Varoufakis. Who is Yanis Varoufakis? Let's look at this. Let's see. He's a Greek guy. He's a Greek economics professor. Former finance minister of Greece. Wow. Okay. He has a YouTube channel too. Right here. Okay. Yeah. If you want to elaborate to viewer, if you want to elaborate on who Yanis is, please let me know. Right, guys. You guys ready for more? Should we take a little break? I have some potato fries here that I could eat a little bit later, but maybe I'll take a little break. Maybe get some more water. Um, we're gonna finish this, man. Um, messaging a viewer real quickly. They have lots of other channel, guys. Sorry. Let me just get back to everything here. Got a little distracted. Okay, let's keep going. So, as chance would have it, while the New York Fed was addressing its severest financial challenge since the Depression, the 10th floor offices of the president were being cleared of asbestos and renovated. Geithner and his staff were working out of temporary quarters on the 13th floor that looked, as one visitor described them, like a Toledo Ramadan Inn. What is a Toledo Ramadan Inn? Rich people references I don't understand. Ramadan Inn? What is this? Ramadan Inn. I guess a slightly lower quality hotel, maybe. Guys, you guys let me know, what is a Ramadan Inn? As you guys can tell, I don't stay in hotels much. That morning, they met with the ubiquitous Christopher Flowers and senior officials from Bank of America who were to discuss the Lehman takeover. They had stayed up all night scrutinizing Lehman's books, and the picture had got worse. One Bank of America official told Paulson and Geithner, "We can't do this without you." He suggested that the government backed about $60 billion of Lehman's troubled assets. Oh my God. $60 billion, bro. When Flowers is leaving, he turned to Paulson. "By the way," he said, "have you been watching AIG?" "What's wrong with AIG?" Paulson said. Geithner had mentioned that there were some liquidity issues, but Paulson had heard that the New York State Insurance Commissioner was stepping in and that a private sector solution was taking shape. "Well, you should take a look at this," Flowers said, and pulled out this spreadsheet he got from AIG the day before. They went back into the office and Paulson examined the numbers. Flowers pointed out the looming multi-billion-dollar shortfall. "Oh my God," Paulson said. He and Geithner asked their staff people to do some fast research on AIG, which, as a giant insurance company, wasn't regulated by either the Federal Reserve and the FDIC or SEC. Although its insurance operations were covered by state insurance regulators, it turned out that AIG did have some federal supervision. Since it owned a small savings and loan, its operations were reported to the Office of Thrift Supervision, which regulates S&Ls? What the heck is S&Ls? What the heck is S&Ls? As in savings and loans? Yes, savings and loans, exactly. S&Ls is savings and loans, which Fed officials called the OTS. Officials were there seemed bewildered by the questions about AIG's liquidity. AIG Financial Products, the center of the problems, was not regulated by the OTS. What the heck is the OTS? Oh, Office of Thrift Supervision. Okay, it's part of the Treasury. Okay. Let me show you guys what OTS is. Sorry, this is it's a little dated because the OTS is something else now. If you guys can see this, go here. Hopefully, you guys can see my screen. The OTS is now called the OCC, the Office of the Comptroller of the Currency. So back then, it was called. There was an OTS and an OCC. So now it's all part of OCC. Okay, I see. A lot of government agencies, right? Some of them doing similar things. That's a common thing when government gets too big.
AIG Financial Products, the center of the problems, was not regulated by the OTS or by any American entity. Although the OTS had warned AIG's board about inadequate risk oversight, no one in the government appears to have understood the potential scope of the problem. The Fed officials needed to talk to Robert Williamstead. We'd better get them in here this afternoon, Paulson said. When Williamstead and other AIG officials arrived, Williamstead confirmed AIG's liquidity crisis, but he said that he was meeting with various private equity firms. Despite the growing cash demands, AIG still had enormous assets, including one of the world's largest investment portfolios. But many of these assets were in AIG's insurance businesses, which were required by the states to maintain assets sufficient to meet insurance claims. I should try to do a monotone voice reading. Let's see if I can do it. The New York Insurance Commissioner was at AIG's offices, and New York's government, no, I can't do it, sorry. And New York's governor was getting involved. The AIG officials were optimistic about finding a way to free up some of those assets so that AIG could meet the cash demands while it pursued other ways to raise capital. Later that evening, Williamstead called the New York Fed. He knew that a Lehman bankruptcy was likely and that it would significantly increase the pressure on AIG with additional collateral calls and a probable decline in its value of its investment portfolio. Williamstead estimated that AIG needed $40 billion, twice the amount he had mentioned earlier, to raise the kind of money he needed government support. Geithner said that none would be forthcoming. So this was the end of Saturday, right? The markets are going to open on Sunday. So it is not looking good. Not looking good, man. Not looking good, guys. All right, let me read some of your comments as we prepare for the cringe when Lehman goes under. Spoiler, Lehman goes under. So Yanis Varoufakis is an economic analyst. He talks about how the U.S. and EU use financial institutions and debt on other countries to support oligarchs in their own countries. Yeah. His book, The Global Minotaur, the Global Minotaur. Let's look this up. The Global Minotaur. Oh, that's pretty cool. The Global Minotaur. So again, not endorsing this book at all, guys. Just showing you guys what a viewer was talking about. This is the Greek economist who talked about. Interesting. So he originally wrote it in 2011, and then I guess he updated it in 2013. Oh, interesting. Okay, pretty cool. Has he written anything else? This is just this one book. Very cool. Very, very cool. Okay, what do you guys think? I'm gonna get more water, guys. Okay, I'm gonna get more water, guys. For those of you watching, just tuning in, we are finishing up this long, extensive article in the New Yorker that summarized the financial crisis and its subsequent actions. This was in 2009. This was an article, a reading I did when I was in economics class in college, and I kept it all these years. I knew, looking back, have many years down the line, we kind of examined some of the claims in here. I'll be right back, guys. I'm going to get more water. I'm going to switch my clothes too because we're about to see red. I think I'm going to put on red. All right, preparing for the fact that Monday is going to be red. So here I am wearing red. Okay, here we go. So this is Sunday, right? September 14th.
It's crazy that all this happened in 2008 around September 11th, man. If it's like the country wasn't dealing with enough stuff already. As anniversary, it was an anniversary right there. I don't know how this happened is the caption. Let me see if I can show you guys. It says, I don't know how this happened. You see that? When at 8 a.m., John Thane returned to Ken Lewis's apartment to pursue the rescue of Merrill Lynch by Bank of America. He sensed that Lewis had grown more eager to make a deal. As Lewis offered Thane coffee, he seemed entranced by the possibility of instantly becoming America's largest retail broker. Thane was growing anxious. The previous night's meeting with John Mack and other Morgan Stanley executives had made it clear that Morgan Stanley couldn't move fast enough. He hadn't yet heard anything about Goldman meeting then underway. Bank of America might be the only option. Lewis was emphatic about one thing. We're only interested in buying 100%, he said. Then it can't be a lowball price, Thane replied. Lewis assured him that he wasn't trying to get Merrill Lynch on the cheap. After about half an hour, Thane left for the Fed. When he arrived, Kelly and Krauss told him that Goldman had proposed buying a 9.9% stake in Merrill and providing a $10 billion line of credit, just what Thane had been looking for originally. Goldman wanted to start examining Merrill's books as soon as possible. Let's get this thing going, Thane said. Kelly called Greg Fleming, who was in Midtown negotiating with Bank of America, and asked him to send a team of Merrill bankers to the firm's headquarters downtown to help Goldman with his due diligence. Fleming balked. That's not happening, he said. He got Bank of America to agree to $29 a share, remarkably high price under the circumstances. If they hear about a Goldman Sachs deal, they'll be spooked. Fleming refused to release any of his team. Shortly afterward, Thane called Fleming. The tone of their exchange was icy. Get people down here, Thane ordered. Fleming grudgingly agreed to send a couple of people, but there was less than 24 hours remaining before the markets opened, and Goldman, a traditional Merrill rival, was liable to walk away once its backers got a good look at Merrill's balance sheet. A Bank of America deal could collapse as well. To some of those involved, $29 a share was beginning to seem wildly optimistic. What this doesn't say, so Bank of America said $29 a share. If you calculated the potential Goldman Sachs deal, how many dollars per share was that? Like, you see how this is bad reporting here. Nobody has context as to what $29 a share means. Like, so you either have to say $29 a share, what that means in billions total, or you have to say what that means compared to the Goldman Sachs, right? Goldman Sachs proposed 9.9% stake and providing a $10 billion line of credit. Like, you're comparing apples to oranges. We don't know why $29 a share from Bank of America would spook Goldman. You see, that's bad reporting. That kind of makes me angry. So far, it's been pretty good reporting, but then he just kind of assumes we're going to understand these finance things that we don't. It's like comparing water to a cell phone. You got to explain how these things are connected. Let me read your comments since that was a little frustrating. That part was a little frustrating. Caramel Dream says it's all a big Ponzi scam. Yep. Yeah. It is kind of true. You know, people in power, right, will use our ignorance / inability to find the right information. It is absolutely true. And, you know, I'm doing the little bit I can to just get everyone on the same page. Wouldn't society be better if everyone knew? I don't know. Maybe not. Maybe that's the whole point. Maybe not. I don't know. You guys let me know. Paulson had been at his desk since 7 trying to organize the day's schedule and meeting with Treasury teams. At about 8, he took a call from John Varley, the Barclays chairman in London. Hector Saints, the chief executive of Britain's Financial Services Authority, felt that he had made it clear to Barclays that the FSA would not approve a deal that put Barclays at risk.
and Barclays had readily agreed. Again, Barclays was trying to buy Lehman potentially, right? Although Barclays was well capitalized and the FSA thought it would weather the crisis, Sands did not believe it was strong enough to absorb all the risk. He worried that doing so might trigger a crisis in confidence in Barclays that could become self-fulfilling. Barclays is one of Britain's largest retail banks with millions of depositors. Sands expected something similar to the kind of backing that JP Morgan Chase had received in the Bear Stearns deal. It didn't matter that Sands, whether it came from the bankers meeting in New York or from the Fed, and he urged Caleb McCarthy, the chairman of FSA, to make this clear to Geithner. McCarthy tried to convey the British concerns to Geithner in a call on Sunday morning, mentioning the issues about Barclays' capital position. He also told Geithner that the FSA lacked the authority to waive the shareholder vote required for Barclays to guarantee Lehman operations. But perhaps McCarthy, in his understated British manner, was too elliptical. AK, he's being too much of a British gentleman. No one can understand what he wanted, I guess. Caleb, are we supposed to use a British accent? Caleb, you have to be denerved. Wait, what? Caleb, you have to decide. Oh, I got the wrong page. Caleb, you have to decide. Geithner said, are you not going to approve this or not? You're not saying no, you're saying not. You're not saying yes. He felt they were talking in circles. One of the British participants said, we could never get charity from the Americans. How's my British accent? When Geithner briefed Paulson and Christopher Cox on the exchange, Geithner, aka the New York Fed president, was visibly angry. Why were the British raising this obstacle so late in the process? Geithner said that he had asked McCarthy 3 times if he was going to block the deal, and he never got a straight answer. Cox called McCarthy and said, tell me what your view is. The normally affable McCarthy seemed cool and detached. My responsibility is that you understand the things that have to be done, he said. I don't see them happening. Cox reported to Geithner and Paulson. He won't budge. Paulson placed another call to Alistair Darling, who had been in regular contact with Prime Minister Gordon Brown and McCarthy. Your FSA is creating a lot of difficulties, Paulson said. You have to understand we have a responsibility to the British taxpayer, Darling replied. The various calls between the Americans and the British that morning remained a point of contention. From the American point of view, there was never a solid proposal that they could respond to. The British, and some on the American side, maintained that the issue of the shareholder vote was a red herring. The British also felt that they were never presented with a deal that they could respond to. It was not a high point of Anglo-American relations. One person familiar with the conversation said, Lehman CEO Dick Fuld had months to find a buyer and hadn't done so. Now that Bank of America had set its sights on Merrill Lynch and Barclays was procedurally hung up, the only way to save Lehman would be for the government to essentially take an ownership stake, a step that would amount to nationalization of one for which government says it did not have the authority. As the Treasury official described the situation, the model had always been Bear Stearns. It was obviously needed JP Morgan to make that happen. Now, we didn't have a JP Morgan, so could we just recapitalize Lehman and keep it going? Did you leave Dick Fuld in place? Do you leave Dick Fuld in place? How would that look? The run was already in progress. There was no reason to think our money would restore confidence in Lehman. As Geithner said, you can't lend into a run. Yep. So there were really 2 issues, legal and practical. Yeah. I'm going to try to turn on my whiteboard here. Let's see if you guys can see my whiteboard here. Turn on my whiteboard, and then we'll very, 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 very simply talk about what a run is. So let's use my whiteboard. Once I confirm that you guys can see my whiteboard, let's see if you guys can see my whiteboard. And once I know that you guys can see my whiteboard, we will talk a little bit about a run. But until then, let's
Our viewer Caramel Dream says Lehman Brothers was margin called. Yep. Yeah. That's a good way to describe them. Yeah. Yeah, they didn't have high level government officials in their pocket. Absolutely. Absolutely. Think about it, right? Hank Paulson used to be the CEO of Goldman Sachs. So obviously, Goldman Sachs had someone that was sympathetic, right? But Lehman Brothers didn't have someone up there. Yeah. I mean, Caramel Dreams, you're absolutely right. Okay. So, um, for those of you who saw part one of this, you guys might see a familiar thing, but let's see, we have a Bank of Jerry, right? Bank of Jerry. Would you guys invest in a Bank of Jerry? And so I have my vault here. I tell people, yo, by the way, you put your stuff in my, let's just be simple. You put your stuff in my thing for a year, right? Let me lend this stuff out to people. And when you take your money out, if you choose to take it out, you can keep it in. I'll give you 10% interest, right? So, oh, this is kind of cool. It's like I'm drawing. Oh, we could do this. Well, let's say this is viewer Caramel, right? So I talked to viewer Caramel. I'm like, yeah, dude, put your stuff in here for a year, please, and then you can get 10% interest. I didn't need to draw this, man. I could have just typed it. You get 10% interest, right? So viewer Caramel, let's say he has $100, right? So he puts $100. To anyone who see this, of course, this is review, right? But we have to make this clear. We have to make this clear. So he puts his $100 into this, right? Let me try to show the dollar sign. So he puts $100 into this for a year, right? So now, ka-ching, I technically have $100 in here, right? So I have $100 in here. So, oh, this is so cool. This is really cool. I got $100, right? That belongs to Caramel. But since I'm a bank, right, I can lend to other people. So let's say, I don't know if viewer Youssef is still here, but let's say viewer Youssef, viewer yourself, sorry, it auto-corrected. So let's say viewer Youssef needs $50, right? So viewer Youssef needs $50. So I tell him, look, I can borrow you $50, but when you pay it back to me, you're going to have to pay me $60, right? I'm going to charge you interest. So my interest in lending is, what is let's look at this. 60 minus 50 divided by 50. What is that? That's I charge them 20% interest, right? So my interest in lending out is 20%. So maybe what I need to do is this part. Oh, shoot. Give me a second, guys, while I try to figure out how to. There we go. Oh, this is cool. Look at that. Look at this. I could move stuff. Look at this. This is cool. I'm so nerding out right now, right? This is cool. So this is cool. So 20%. This is cool. Right, obviously I'm a bank, right? I want to make more money. So of course I'm going to charge more money lending out than the money I give back to people. Right? So we're going to do a little T-sheet here. Oh, there's an arrow here the whole time. Oh, guys, sorry. This is my first time like using the whiteboard on right? So sorry guys, I'm failing with the whiteboard. I'm like, I don't know how to work this. Sorry guys. I'm just gonna calm down. I don't wanna. I hope you guys are having fun with me. Try to work Blackboard. Like this is such a millennial moment. Like a Gen Z kid would totally be able to figure this out. It keeps auto correcting to yourself. and now I messed it up. Now it's too big. Sorry, guys. There we go. There we go. Now it's better. um, I'm just basically saying what my assets and my liabilities are. Right. These are my liabilities. These are my assets, et cetera, et cetera. Now, the the central part to all this is, so I have $100 in my vault from viewer Caramel, right? And then I lent 50 of that 100 out to Yusef. So Yusef has $50 that he can use right now, and viewer Caramel has $100 that's technically his that he promises not to use for a year. So technically now there's $150, right? There's $150 floating in the economy right now, right? I created income. I believe viewer Caramel was the one that said it. I created income endogenously, right? Now there's $150. Even though it only was $100 from viewer Caramel, but because he stored it in my vault and then I lent 50 of it out, there's 150 now, right? That's how banking works. It's kind of sketch. It's so much of it is based on trust. So let's say someone else. Who else is in the audience that we can use as an example? Can I borrow some money from the Bank of Jerry? Says Caramel. So let's say viewer Sandman. So we'll have viewer Sandman here, right? Viewer Sandman. So viewer Sandman 24. Why is this not big enough? Again, I'm having millennial moments right now. I'm like not able to work this stupid. What's going on? Why? What the heck? What the? Okay, anyways. So we have viewer Sandman. Oh yeah, I could do this. Let's say he needs $100, right? So viewer Sandman needs $100, and I've lent $50 out already. So again, I'll charge viewer Sandman some interest. I'll say, well, look at you, man. You're borrowing a lot more than viewer Yusef. I'm gonna charge you, I don't know, 30% interest, right? So 30% interest. Why did it shrink? Why? Oh, there we go. So I'm charging him 30% interest, right? For you give it back in a year. So now suddenly, look how much wealth we created. there's 200. Oh yeah, I drew that. Oh, I could delete that though. Okay. So now there's $250. Technically, right? There's $250 floating in the economy. all from all from the $100 that viewer Caramel wanted, right? So again, we can add that to our T sheet here. Now, what if someone else comes along? Let's say we have someone. Let's see. Let's say a guy named Viewer Z comes along, okay, and he needs a lot more money, right? So let's say he needs
He needs $500. Uh-oh, but I don't have enough. So what do I do? Well, maybe there's someone here. Let's call it the Bank of Gary, okay? Bank of Gary. Now, I can borrow from Bank of Gary, right? But of course, if I'm going to borrow from Bank of Gary, Gary's going to charge me, right? Gary's going to charge me an interest rate too, right? They're not. We're all in the business to make money, people, right? We're not a free. So they're going to charge me an interest rate here, right? So one of the things that the Federal Reserve does, I guess, since we're just nerding out over this, the Federal Reserve can affect this rate, can change this interest rate that banks have between them for borrowing. So it's called the federal funds rate. So the Federal Reserve can manipulate the federal funds rate, which impacts the interest rate that banks, at the end of the day, lending their excesses to each other. Again, it's very complicated. The Fed has a lot more that it does, but this is one of the things it does. Anyways, I nerded out about all this, but I didn't even explain what a run is, okay? So let's say viewer Caramel decides, Jerry Sketchman, I don't like him. And he says, you give me back my money now. I don't care if your rules say I have to pay a penalty. So let's say if viewer Caramel wants to take his money out tomorrow because he doesn't trust me anymore, I'm charging him a penalty, right? So let's say I penalize him $50, so he gets to take $50 out. But still, now that the money's gone, right? I don't have enough to lend to other people. So let me actually illustrate this. Let me illustrate this better. Let's say we have a bunch of other viewers. Let's say collectively we have 3 more viewers, and they've all put let's say they've all put $100, right? Each. Oh shoot, what the heck? So let's say at this point we've also lent that 500 to the viewer, right? So we've lent a lot of money, right? We've lent all that money. So technically we don't have enough money to give back to people if they wanted, because again, the contract was that they were supposed to put it in our bank for a year. But what if viewer Caramel and 3 other viewers who put $100 into our bank, it's like, Jerry's untrustworthy, man. We don't like this guy, right? So they want to take their $100 out, even if there is a penalty. Well, I literally don't have money, right? I don't have money to give to you guys, right? That's how financial institutions fail. I nerded out so much in the beginning that I don't know if I explained this part correctly, but I just wanted an excuse to use the blackboard. The point is, because of how banks work, banks lend out the money that you put in there, which means only a little bit of what a bank has it can actually give. Let me phrase this correctly. A bank only has a little bit of stock in its, not the right word, stock. It only has a little bit of reserves as in actual money. So if too many people that put their stuff into the bank actually try to take it out, the bank doesn't have enough, right? That's why I said in the very beginning, it's all based on trust. It's all based on trust. So what that means is, if too many people try to take stuff out from the bank's going to fail unless it can borrow from other banks or it can get the government to bail it out. And so think about this little analogy I showed you, the Bank of Jerry. Put it on the bigger scheme. Imagine hundreds, thousands, hundreds of thousands, millions of people putting money in, taking money out. And now it's not just money, it's stocks, it's bonds, credit default swaps, mortgage backed securities, all that stuff. A whole mess of things, right? But fundamentally, it goes down to the fact that banks sort of create money, but they don't create money because it's all based on trust. And if people don't believe in the bank, everything fails. Everything falls apart. The people that put their money in the bank it falls apart. The people that borrow the money, it all falls apart. All falls apart. Again, I think I nerded out too much. I take responsibility for being a millennial and not figuring out technology well, not explaining that completely well. You guys let me know if that was a good explanation. Okay, it was funny enough, or you need a more explanation. But let's go back to this. Oh yeah, I mean, Caramel's talking about how I didn't really explain it well because I didn't take into account fractional reserve. Yeah, I understand that. I know, like the I didn't want to talk about fractional reserve because again, that complicates it. But yeah, technically, banks have to have a certain amount, right, in their reserve. Whatever. If you guys really want to look into this, it's something called fractional reserve. So, anyways, yeah. Where were we? Yep. Referring to the Lehman failure, the Treasury official said, "We knew it would be awful." At the same time, after months of turmoil, anyone still owning Lehman stock or commercial paper had to be considered a speculator. Commercial paper. They literally called it commercial paper. They called it commercial paper. Oh, what a world, bro. What a world. He literally called it commercial paper. Perhaps investors will stop assuming that the government will bail out every wayward financial institution and adjust their risk taking accordingly. Everybody in some part of their brain thought it was a good thing for Lehman Brothers to go under. The Treasury official said, "Was this 10% of the brain? I don't know, but the thought was there somewhere." At noon, Stephen Shafran, a senior advisor at the Treasury, text messaged his colleagues, "We lost the patient." Oh no. When the chief executives of the banks met again that day at the New York Fed, they expected Geithner and Paulson to tell them exactly how much they would be expected to contribute to a Lehman rescue. Instead, Paulson, Geithner, and Cox all looked grim as they filed into the room, trailed by various Treasury and Fed staff members. "The Barclays deal has fallen through," Paulson said. "You should expect a Lehman bankruptcy." Hastily summoned late that afternoon to the New York Fed, Harvey Miller, Lehman's head bankruptcy lawyer, joined a group of Lehman executives and officials from the Treasury, the Fed, and the SEC. Tom Baxter, the general counsel for the New York Fed, began reiterating that Barclays' deal had fallen apart. There was no rescue for Lehman. "What's the next step?" Miller asked. The next step was bankruptcy. You have to file by midnight. Miller and his lawyers hadn't even started drafting papers. That day before, when he heard from Fed officials, he hadn't sensed any urgency. "You don't realize what you're saying," Miller argued. "It's going to have a disabling effect on the markets and destroy confidence in the credit markets. If Lehman goes down, it will be Armageddon." All the government officials filed out to discuss the timing of the bankruptcy, leaving the Lehman officials and lawyers to speculate about their fate. When they returned, Baxter told them that they had not changed their view. Lehman Brothers should file by midnight. Jeez. You give a company half a day to file a bankruptcy. Why? Miller persisted. "There's no way that could happen. There's been no preparation." Raising his voice, he added, "We just want to understand." An outside lawyer for the Fed told Miller that he wasn't being constructive by continuing to argue, and Baxter agreed. "The decision has been made and it won't be revisited," Baxter said. Fed officials didn't feel that they had time to discuss the weekend's events in detail with Miller. Their goals were to make sure that Lehman officials and their lawyers understood that there would be no reprieve and that the company had to file for bankruptcy before the markets opened on Monday morning. The alternative would have been chaos, Baxter said. Everyone would have known that the weekend's rescue efforts had failed. You'd have had a mad dash for assets worldwide, aka run, right? A run. Yeah. Yeah. Half a day, man. Half a day for Lehman Brothers to wow. As Miller, the bankruptcy lawyers, and Lehman officials returned to Lehman's headquarters in Midtown, a bearded man was pacing the sidewalk waving a placard that read, "Down with Wall Street." Word had spread that in the event of bankruptcy, the building would be locked down and its contents seized. Employees were streaming out carrying suitcases, pulling rolling bags, carting off their personal belongings. Jeez. When the group reached the boardroom on the 31st floor, the directors were already meeting. After a lawyer briefed the board on the government's verdict, Dick Fold, the CEO, shook his head. "I don't know how this happened," he said. Another director asked plaintively, "They bailed out Bear, why not us?" Fold's secretary came in and handed him a note. "Hold on," he said. "Something unusual is going on. Chris Cox wants to address the board." The SEC chairman, along with Baxter and SEC Fed and Treasury staff people, were put through to the speaker at the center of the table. Paulson had put pressure on Cox to call the Lehman board and encourage Lehman to file for bankruptcy immediately. Cox felt that it was inappropriate for the government to interfere with the board's decision. Instead, he stressed that Lehman's board had a grave responsibility, a fiduciary duty to shareholders. He told them that the Treasury and the Fed believed that market conditions were such that what they did would heavily affect the market, and timing was crucial. "Are you directing us to put Lehman in bankruptcy?" one director asked. Cox said no. Then there was a pause as he conferred away from the phone. When he returned a minute or two later, Cox said, "No, the ultimate decision is yours. We can't interfere in corporate governance." We can't really tell you what to do, but we're telling you what to do. That's what this is saying. Baxter added, "But our preference was made clear today at the Fed." After an hour of discussion, the board voted unanimously to file for bankruptcy. I guess this is goodbye. Okay, wow. See what I put on red? So Lehman's gone, right? And then they have to deal with AIG. AIG's efforts to raise capital or free assets from the regulated insurance companies stalled as the company kept increasing the estimate of the amount of capital it needed. Understandably, no one wanted to contribute $20 billion, only to discover that it had vanished as AIG's cash needs continued to soar. But after more than 2 days of nearly round-the-clock due diligence, Flowers and his colleagues were ready to make a proposal to rescue AIG. Flowers had enlisted top officials from Allianz, the giant German insurance company, who had flown to New York the day before. At 3 p.m., they met with Willemstad in the conference room outside his office. Flowers proposed that his firm and Allianz buy AIG for $2 a share. AIG shares had closed on Friday at 12. Ooh, that's a big lowball. They would acquire assets of the subsidiaries, but would need to be insulated from the liabilities of the parent. Flowers and Alliance would contribute $5 billion each in new capital. Flowers' offer was conditioned on receiving Fed support. So there was another condition. Willemstad and AIG's top management would be replaced immediately by Alliance executives. Willemstad thought that the proposal was laughable. He thanked Flowers for his efforts and asked him to leave. So AIG didn't accept it. It's getting interesting. That afternoon, Merrill Lynch worked out the details of the company's sale to Bank of America. It involved no cash, but a share exchange that indeed valued Merrill at $29 a share. The Merrill Lynch board meeting by the phone approved the deal. Oh, so Merrill Lynch approved. It was the $29 a share. Okay, it's sold to Bank of America. It was unanimous. You have a deal. Around 7:30, Thane and his entourage walked from Merrill on Fifth Avenue to the office of Bank of America's legal firm, Wachtel, Lipton, Rosen, and Katz on 52nd Street, where Lewis and other Bank of America executives were waiting. Bank of America's board had also unanimously approved the deal. The Merrill bankers got a taste of the different culture they would be joining. It was South versus North, traditional banking, blue collar versus trailblazers, the masters of the universe. One Merrill participant recalls, I began to get a hint of the resentment toward Wall Street. This acquisition was tinged with resentment that went beyond the numbers. It was as if the tortoise had eaten the hare, and they were not very good at hiding it. Flowers had just arrived from AIG to deliver the fairness opinion on the $29 price for Bank of America shareholders. Given that it was a stock deal, Merrill shareholders would receive no cash. Bank of America would also had some protection. If general market conditions deteriorated and Bank of America stock declined, the price of the Merrill deal would drop accordingly. Flowers concluded that $29 a share was a plausible price. For this advice, which had subsequently been criticized, Flowers, an affiliate firm, were paid $20 million by Bank of America. Jeez. They're all giving each other bonuses, right? According to a complaint later filed by the SEC, the agreement also included a document not made public at the time that authorized bonuses to be paid to Merrill employees for 2008. Even though Merrill's results weren't yet known for the full year, ultimately the firm lost more than $27 billion. The document allowed for bonuses that do not exceed $5.8 billion. Sorry, I read that wrong. Ultimately, the firm lost more than $27 billion. I said million, I believe. At this point, like, it's just too much money. My mind's going crazy. The document allowed for bonuses that do not exceed $5.8 billion in aggregate value. Bank of America now says that the document was not disclosed for competitive reasons. While lawyers continued working out the details, Thane and Lewis went to a small conference room to await news that they could sign the merger documents. A bottle of chilled champagne and 2 glasses had been placed in the room to toast the completion of the deal. Thane felt that he had done the best he could for Merrill shareholders. As the time passed, Lewis grew impatient and called several times to ask where the papers were. Finally, just before 1 a.m., so technically it was on Monday, they arrived. The 2 men signed and then poured the champagne. Neither one said anything about Thane's future with Bank of America. I look forward to a great partnership with Merrill Lynch, Lewis said, raising his glass. He grimaced. Champagne was warm. So that was Sunday, man. That was Sunday. We're about to get to Monday, right? Because obviously we know a lot more stuff happened. Like Wachovia fell, right? Wells Fargo bought Wachovia. So a lot of crazy stuff happened. So this is just the beginning. So AIG wasn't saved, and Merrill Lynch got bought by Bank of America, and then Lehman Brothers wasn't saved, right? So basically we had Lehman Brothers and AIG, and we all know, looking back on this, that the government saved AIG but didn't save Lehman Brothers. So I'm going to take another break, and then let's keep going. I'm going to finish this, man. I'm already halfway through. Oh, I'm not. Yeah, I am halfway through. Yeah, so we're going to finish this. I'll take another break. You guys talk in the live chat, and then we're going to look at what happens Monday. For those of you tuning in right now, we're reading about those essential days during the financial crisis, right? When certain firms were saved, certain firms were not saved.
Be right back, guys. All right. So Mark W came. Welcome, Mark W. For those of you tuning in, we are now Monday, September 15th in 2008. And a lot of you know the financial sector in America was starting to fall apart in 2007, but a lot of it wasn't felt until a year later. So they had a real estate bubble, right, caused by a lot of things, but low interest rates, artificially low interest rates was one thing. And maybe we should do some more drawing. Hey, let's do some more drawing. Might as well. Let's do this. We had a lot of fun with this, so we're gonna draw some more because Jerry likes pictures. So, um, and then can you draw curves? Can you draw curves on this? I'm just gonna draw it like this then, right? Something like that. Something like that, right? Sorry, I didn't draw a really good but basically, right. This is what I drew yesterday, but on a piece of paper yesterday. For those of you who weren't here yesterday, can I even find? Oh yeah, here. I don't know where I put it, but I drew a bunch of pictures. But as the interest rate goes up, right, more people want to invest or save, whatever you call it, right? They want to, because you can make back more money if you put it away, right? But as interest rates go down, more people
are going to want to take out loans, right? Because again, the amount you have to give back extra is less, right? So if you let the market decide, theoretically, ideally, there's some point that it's like a market equilibrium type of interest rate. Now, a government, for various reasons to stimulate the economy or whatever, will try to artificially lower the interest rate, right? They'll try to be like, oh, we're going to set the interest rate down here, right? So you sort of artificially create. Oh, I messed up the last part of but you get it. So you artificially create this lower interest rate here, right? But what you end up doing is, because this isn't actually the right price signal, you make people that otherwise might have not been taking out loans take out loans, and then also people that otherwise might have saved are not saving, right? I mean, I think this is the most basic way of explaining this. So you create two little points here. Let's see. Again, sorry, I sort of messed up the graph a little, but the other way to think about this is sorry. This is what happens when you're not a young person anymore, when you're a millennial, but you realize I'm not. Like, when you're fumbling with technology, you realize, oh, F, man. So, anyways, so you have, I guess it doesn't matter, but we'll call this consumption. We'll call this investment, right? If you invest all your money, you put it all in a bank, you put it all in stocks or whatever, you don't have money to spend, right? You spend all your money, you don't have anything to save, right? So in the aggregate, it's somewhere on this line here, right? So let's say this was, if you left the markets alone, right? I'm just drawing a line down here, right here. This is what, if you add everyone up, this is how much there's savings in the economy, how much there's investment in the economy, how much people are spending, right? Now, the government lowers interest rates and then changes it up a little, right? So makes it look like there's a boom, makes it look like, oh, look at that, the economy's doing much better because we pumped money or we did other things, right? So it's out here. But what you're actually doing is you're creating an imbalance here. So you see this? So before, there would have been this many people consuming, spending money. But now there's more people spending money. And then top of it here, there's more people investing their money that shouldn't be, right? You're creating by messing with the price signals, by messing with other things in the marketplace, you're causing people's behavior to change, basically. That's the best word to describe it. You're changing people's behavior for the worse. I hope this makes sense. If you can understand this, then you can understand why. And then, okay, beyond this, right? Then the federal government's also trying to say stuff like, oh, we got to encourage house ownership. We got to A, B, C, and D. So then a lot of you probably heard of things like ninja loans, right? Ninja loans. Right? So the government's encouraging more people who shouldn't be taking out loans to take out loans, right? So there's a lot of things going on wrong. But basically, all this stuff was happening for years. And then 2007, it started falling apart. And then everyone felt it in 2008, right? When these big financial institutions were collapsing. Anyways, I like drawing graphs. I hope those graphs were fun for you guys. But anyways, so we're at this point. Lehman Brothers is about to file for bankruptcy.
And Bank of America saved Merrill Lynch, saved quotation marks, and AIG refuses the proposal by this Flowers Company plus Alliance. So, who's going to get bailed out is the question. Bruce R. Rent Sr., the chairman of the Reserve Management Company, which ran the country's oldest money market fund, had just arrived in Rome, where he was planning to celebrate his 50th wedding anniversary, where his son, Bruce Bent II, the firm's vice chairman, called him from New York. In his absence from the office, Bent relied on his son, whose shoulder-length hair and beard made him look more like the philosophy major and drummer he once was than an executive of a renowned money market fund. The subject they discussed was Lehman's bankruptcy. The Bent's money market fund owned hundreds of millions of dollars of Lehman debt securities. The elder Bent, along with the firm's late co-founder Henry Brown, had invented the money market fund in 1970. The company's primary fund had begun operating in 1971. At that time, yields on bank deposits were capped at about 5%, but short-term U.S. Treasury bonds, which could be acquired only in $10,000 increments, were yielding 8%. So, Treasury bonds were yielding more than yields on bank deposits. So there's an incentive back then to invest in Treasury bonds, especially Treasury bonds usually aren't subject to federal taxes. Actually, it depends. It really depends. But Treasury bonds are definitely not subject to state taxes. But it depends on what Treasury bonds you get when it comes to federal taxes. But yeah, for people looking to use the tax code to help themselves, right? Treasury bonds are usually a pretty good investment. So at that point in the 70s, Treasury bonds were yielding 8% interest. So the investments were ultra safe, and since they had short-term maturities, there was little risk from changing interest rates. In addition to U.S. Treasuries, some money market funds began buying commercial paper, short-term debt that companies used to fund their operating expenses. I like that they just made up a name, short-term debt. It's called commercial paper. By September of 2008, money market funds had become a $3.5 trillion market. And many large corporations had come to rely on them to meet their day-to-day cash needs, such as making payroll. You're paying your employees through money market funds? Huh? Okay, all right. Again, so much of just everything in our current crony capitalism or a half capitalism, that was the term I made up in the first video I did on this. So much of our half capitalist society is based on trust. Unlike bank deposits, the funds weren't covered by federal deposit insurance, but they were perceived as equally safe. And why not? In 40 years, the net asset value of funds available to the public had never fallen below $1 a share, a hypothetical possibility known as breaking the buck. Many funds carried check-writing privileges, helped to finance the federal debt, and provided large corporations with an important source of liquidity. Okay. For years, the elder Bent had insisted that money market funds should confine themselves to treasury bills and bank certificates of deposit. But in 2006, as other firms made huge profits, the primary fund began buying highly rated commercial paper, aka short-term debts, as well. From November 2007 through the summer of 2008, it increased its purchases of Lehman securities. Thanks in part to the higher yields from such assets, the primary fund's one-year return was 4%, well above the comparable rate for treasuries, and high even by money market fund standards. Both Moody's and Standard & Poor's, so those are credit rating agencies,
gave AAA ratings to primary fund. Individual and large institutional investors flocked to the firm, and its assets rose to nearly 63 billion. About 1.2% of those were in Lehman commercial paper and other securities, enough theoretically to break the buck if the assets lost their value. Even as Lehman's situation deteriorated, the elder Bent had remained confident that the assets were secure. 2 days before leaving his vacation, he had declared on CNBC that because of Lehman's importance to the world's financial structure, the Federal Reserve window that they opened after they closed. Wait. Because of Lehman's importance to the world financial structure, the Federal Reserve window that they opened after they closed down Bear Stearns should be available to Lehman for the same type of situation. Okay, yeah, it was just a long sentence. AKA, please bail out Lehman. That's what he's saying. It was now publicly known that the primary fund was exposed to Lehman's failure. You see how the dominoes basically falling, right? Time Warner, which had 820 million in the fund, requested redemptions that morning. The Bents contacted the New York Fed at 7:50 a.m., according to SEC documents, to express concern about Lehman's effect on money market industry and on the primary fund. But the gravity of this crisis apparently had yet to sink in. Judging from the transcript of the Reserve Management Board meeting at 8 a.m., which was released by the SEC, Bent II suggested that his father preside. "You got more sleep than I did last night." "Last night I was sleeping on the plane from New York to Rome," his father said. "I said to my wife, this is supposed to be a memorable trip. And she responded, well, it certainly will be, right?" Bent II reported that as of that morning, the primary fund was facing $5.2 billion in redemption requests. In assessing the value of the Lehman holdings, the elder Bent initially argued that they continued to carry the Lehman debt at par, or 100% of face value, even though, according to SEC, the market data the Bents had seen suggested that there was no real market for Lehman debt and that bids ranged from 45 to 50 cents. At a second meeting, the board settled on 80 cents on the dollar, enabling the fund to calculate a net asset value of 99.75 cents, which could be rounded to maintain the $1 net asset value. At the same time, the board decided not to try to sell the securities under current market conditions. And so it's going to go down and down and down, right? At the third board meeting at 1 p.m., Bent II reported that redemption requests had reached 15.5 billion. According to the minutes, he described what appeared to be a run on the primary fund, but he didn't mention that State Street, the fund's custodian bank, had called to report that a huge number of redemptions had caused the primary fund's account to be overdrawn, and the bank was suspending overdraft privileges. According to SEC, anyone seeking to withdraw funds cannot immediately get his money. Which, then that would create more people trying to withdraw, right? That's how a panic happens. The credit markets were barely functioning, and the fund couldn't raise cash to meet redemption requests by selling its normally liquid assets. As the chief investment officer put it, according to the transcript of the board meetings, this was the kiss of death. He also said Paulson and Bernanke totally effed this up. Pronounce it, you know what he said. "I don't think they thought this GD thing through to figure out what the ripple effects would be." Bent II said that the company would try to secure additional financing or inject capital from the holding company, Reserve Management. The board vetoed to pursue that strategy, and sales representatives launched an effort to stem the withdrawals and reassure shareholders. One told a client, according to FEC documents, "We have a backstop and are going to ensure that the fund does not break the buck," aka go below $1. Yet, at the end of the day, redemption requests totaled more than 20 billion. So it went from 5.2 billion to 16.5, now to 20 billion. a little less than half that had been funded, with reserve management personnel blaming the delays on the market and limits placed by State Street. As the chief investment officer summed up the situation in a call to other reserve officials, it's just effing horrific. I'm thinking, we're going to get through this. We're going to get through this. We're going to get through this. But, I haven't seen the market like this in 30 years. This is like depression. Nevertheless, after the market closed, reserve management reported that it would be able to maintain a net asset value of $1. Okay, some hope, right? You see, the dominoes are really falling. Angst Vision is here. What's up, Angst Vision? So, whatever officials at the reserve management company thought of Paulson, when he returned to Washington, he was greeted with overwhelming praise for having let Lehman Brothers fail. Calls to his office, he says, some from members of Congress were running 10-1 in favor of the decision. The government had to draw a line somewhere, the Wall Street Journal wrote in an editorial. Treasury Secretary Hank Paulson's refusal to blink won't get any second guessing from us. After reporting to President Bush, the dictator was the president at the time, for those of you who don't remember, Paulson met with reporters in the White House briefing room. As you know, we're working through a difficult period in our financial markets right now as we work off some of the past excesses. He said, but the American people can remain confident in the soundness and the resilience of our financial system. Still, even as Paulson was speaking, the Dow Jones Industrial Average was dropping. By the end of the day, it was down 504 points, or 4.4%, the biggest one-day percentage drop since the first day of trading after 9/11, 2001. Traders aware of AIG's mounting collateral calls and the ongoing meetings at the New York Fed were unloading positions. AIG shares dropped 61%. Wow. The last remaining independent investment banks on Wall Street were hit hard too. Morgan Stanley shares dropped 14% and Goldman's 12%. Of course, Goldman suffered the least, right? Because Henry Paulson was the Treasury Secretary and he used to be the CEO of Goldman. Yeah, the dominoes are falling, people. Dominoes are falling. I'm going to eat my oranges and I just realized I forgot my water again. Take a little break, you guys. You guys have anything to add about where were you guys during this period in September in 2008? Got my orange. Yeah, I got my orange. Eat 2 oranges before we. Second orange. For those of you tuning in, if you want to read ahead or you haven't read this ever, it's this article. I linked it in the description. Really great article from December of 2000 and September. It was published September 2009. So basically about a year after all this happened, right? He had enough research. Of course, a lot of the people in the government side of this wrote books on this because they're sort of trying to vindicate themselves, right? Because a lot of them got criticism after this.
Get my water. I'll be right back. All right, let's keep going. All right, 11 a.m. Monday, the 15th, 2008. The fourth consecutive day, investment bankers filed into the New York Fed. I don't think I can take another day of this, a Goldman banker told Lloyd blank fine as they got out of the Goldman car. If you're going out of a Mercedes to go to the New York Federal Reserve, blank fine responded, you're not getting out of a Higgins boat on Omaha Beach. I don't get what that means. It's like rich people humor. This, if any of you know what that meant, you guys can let me know. What's it? Maybe we'll just look it up. What's a Higgins boat? Again, I don't know. I don't know. Above my pay grade, above my tax bracket. You guys let me know if you know what a Higgins boat is. The subject of today's meeting was AIG, where cash was vanishing at an alarming rate. There will be no public support for AIG, Timothy Geithner, New York Fed president, announced. He asked the bankers to explore an industry solution. Earlier, he had called Robert Willemstad and said he wanted him to appoint J.P. Morgan Chase, already working for AIG, and Goldman Sachs to organize a syndicate of banks to reach a solution. By now, all of AIG's possible rescuers had vanished. A person who spoke with potential buyers says they went from keenly interested to not wanting to touch it at any price. By 5 p.m., the syndicate efforts had collapsed. Geithner had a Fed team working on AIG, and at midnight, he convened the team, some of whose members were participating by phone from Washington. Can we let it go? He asked. AIG Financial Products, the primary source of the company's troubles, had a 500 billion credit swaps portfolio. 500 billions of bad credit swaps, man. That fell outside the regulatory purview of the Fed, the Treasury, and the SEC. The company's failure to honor those contracts will make the payments. The company's failure to honor those contracts and make the payments would render numerous banks and other financial institutions unstable as they wrote down the value of suddenly uninsured and unhedged positions. This could precipitate a crisis of depositor confidence and a global bank run with potentially catastrophic, unforeseen consequences. As AIG officials later put it in a presentation to the Fed, AIG did business in more than 130 countries and had 116,000 employees and 74 million customers, including 30 million in the US. Wow, they actually had more customers abroad. Of course, the US was probably their most concentrated market, right? But that's crazy. They had 44 million customers outside of America. Wow. As the discussion continued, a consensus emerged that AIG was indeed too big, or at least too deeply enmeshed in the global financial system to fail. At 2 a.m., Geithner urged everyone to get some sleep. Okay, we're about to get to Tuesday, September. Wow. AIG had 44 million customers outside of America. Wow. Just take time to process all this, right? Wow, we're into hour 2. So All right, guys. Tuesday, September 16th, 2008. That morning, Willemstad called Geithner again. He said that he was planning to draw down the last of AIG's credit lines that morning. Traders and investors would recognize such a step as desperation, making bankruptcy all but inevitable. Don't do that, Geithner said. Why not? Willemstad asked. Unless you can tell me there's a solution in place, I have an obligation to shareholders. Don't do it. I'll get back to you. Geithner hung up. An hour passed, hearing nothing. Willemstad gave the order to draw down the credit lines. Then at 11:30, Geithner called and told him that an emergency meeting was underway at the Fed in Washington about a potential solution. Willemstad hastily rescinded the order. It was becoming clear to Geithner that Bernanke that government action was the only recourse. Every financial institution was struggling to value assets at a time when there were fewer buyers for them at any price. Financial institutions were growing reluctant to lend to one another, even overnight. That day, the Fed put $70 billion into credit markets, but with little effect. European central bankers were also grappling with the rapid deterioration of credit markets and were deeply concerned about the impact of an AIG failure on European financial institutions and markets. Several European central bankers had spoken with Bernanke, urging the Fed to do whatever it could to prevent an AIG failure. So what the heck does it mean by putting $70 billion into credit markets? What exactly is that? 70 billion. I guess we'll have to look this up. What does that mean by putting 70 billion into credit markets? Like, what confuses me is the word put. Like, how does it put 70 million? Right? It's not effective when you ask, what do you mean? Because you're not explicitly explaining to people what you're confused by. The word I'm confused by is put. Like, what does put 70 billion? What does that verb put mean? So let's look this up. How the Fed puts money into credit markets. Let's see. Let's look at this. Let's look at this. I'm going to share my screen. Oh, yes. So it can buy, right? It can buy and borrow treasury bills. Okay, yeah. So that's how it puts money into the. There we go. Yes, that kind of. I learned all this back in the day in economics, but I forgot it. But yeah, it's buying what are called treasury bills. Right? To buy a treasury bill, it's paying in money, right? That's like it's counterintuitive, but it's to buy a treasury bill, it's paying money. So it's actually injecting money by buying something. Yeah, exactly. We'll add cash to the accounts. Exactly. So yes, it can inject M1, M2, M0. I never learned about what is M0? M0? I like that they discontinued M3 now. Huh, so funny. They don't really talk about M3 anymore. Okay. All right. Yeah, you can also do the federal funds rate, which I talked about earlier. Let's see what other they can print money too, right? Let's see. Oh, credit market funnel. There we go. This is it. Oh, it's all about fractional reserve. Yeah. Yeah. So it's not
it's not printing money per se, right? That's the treasury, but it causes money to be printed. So that's sort of a clarification. Okay, it's the treasury. It's the treasury bills. Anyways, it's like I had to get that clarified. Um, hmm. Letting AIG collapse would be disastrous. AIG was even larger than Lehman, with a substantial presence in derivatives and debt markets as well as in insurance markets. So AIG had their hands in more jars. Uh, Bernanke later recalled, given the extent of the exposures of major banks around the world to AIG and in light of extreme fragility of the system, there was a significant risk that AIG's failure could have sparked a global banking panic. If that had happened, it was not at all clear that we would have been able to stop the bleeding given the resources and authorities we have had available at the time. Geithner and Paulson proposed extending an $85 billion loan that would be collateralized by all of AIG's assets. AIG did have several large, profitable businesses, including its main insurance arm, which gave the Fed a legal basis for making the loan. The government would also demand a nearly 80% stake in AIG, which would have the right to veto any dividend payments. Wow. So basically, AIG would have become like a government institution, right? There was great reluctance, one participant recalled. People were uncomfortable. We just crossed another boundary. AIG wasn't a bank or a broker dealer, but an insurance company. Could we let it go? No one had any idea what would happen if we let a company this size fail. There was no precedent. We were aware that lots of banks and investment banks were counterparties and might be at risk, but we didn't do this to save Goldman or SocGen or Deutsche Bank. It was far more complex. We were worried about the households with 401k plans, life insurance policies, and pensions. The discussion lasted 30 minutes. There was no real basis for knowing whether AIG's healthy businesses were sufficient collateral. Still, Bernanke said recently, Lehman was insolvent and didn't have the collateral to secure the amount of Federal Reserve lending that would have been necessary to prevent its collapse. In contrast, AIG Financial Products was just one division of a big global insurance company. But some Treasury and Fed participants recognized that giving AIG a $85 billion loan so soon after Lehman's collapse would appear wildly inconsistent. Opposite decisions were made for apparently similar reasons. The Treasury official says it was hard to justify, but AIG was another order of magnitude. It was a quantum shift. It was so beyond anything we'd ever envisioned. Huh. I get it, right? It's saying AIG got a lot of other things that are good. It's just this one arm of it really messed up with the CDS. So if this one thing drags everything else down, maybe not good, but save it, help AIG, let it take care of this one thing. And then since the government has 80% of an equity stake, right, eventually once AIG gets back, the taxpayers make it back, right? They'll make it back. And in fact, this was true. The taxpayers, when AIG got bailed out by the loan, eventually the taxpayers did make back all that money. So from a financial standpoint, it was fine. Now, from a moral standpoint, right? I don't know. It's just, but yeah, knowing now what we know, that the saving AIG didn't end up costing the taxpayers in the long run, if that makes sense. Although you could argue you messed with our democracy, you messed with our capitalism, so maybe it did hurt us in the long run. And of course, it was still a wealth transfer. Maybe I take that back. What do you guys think now? Let's see if there's any comments in the live stream. Nope. All right. That afternoon, President Bush, the younger Bush, accompanied by Josh Bolten and Joel Kaplan, his chief of staff and deputy chief of staff, and by Keith Hennessy, the director of the National Economic Council, sat down with Paulson and Bernanke in the Roosevelt Room of the White House. So what is going on in our financial system? Or as Bush said, so what is going on in our financial system? And what are we going to do? Bush asked. Paulson regularly delivered updates to the White House, but from the outset of his tenure as Treasury Secretary, He had been making policy to an extraordinary degree. Bush saw himself as a wartime president. He was deeply involved in defense issues. Are you sure? Are you sure it's not Cheney? The economy was secondary. One person who worked with Bush for many years said, "My sense is this came up in the final months of an 8-year term. He was so ground down by Katrina, the war in Iraq, he was just out of gas." A government official added, Hank Paulson and the Treasury were unilaterally making economic policy for the administration. There was no influence from the White House. AIG is about to fail, Paulson told Bush, warning about a potential collapse was likely to be catastrophic, especially with markets still highly unstable after the Lehman failure. Bernanke explained AIG's credit default swaps and the likely consequences that AIG's failure would have on major U.S. and European banks. He also described the limits on the Fed's power to deal with an institution like AIG. How have we come to the point? How have we come to the point where we can't let an institution fail without affecting the whole economy? Bush wondered aloud. Bernanke reiterated that what had begun as a subprime mortgage problem in the U.S. the year before, 2007, was emerging as a global crisis, which made it even harder for the Fed to combat the problems on its own. When Bernanke and Paulson finished, Bush said, "Sometimes you have to make the tough decisions. If you think this has to be done, you have my blessing." But as he rose to leave, he said, "Someday you guys are going to need to tell me how we ended up with a system like this. I know there's not the time to test them and put them through failure, but we're not doing something right if we're stuck with these miserable choices." Despite efforts to calm the shareholders in the primary fund, Bruce Bent II reported to the board that morning, and redemption requests at 9 a.m. stood at 24.6 billion. So it went from 5.2 to 16.5 to 20. Now it's at 24.6 billion, just in 2 days. He also told the board that reserve management had not arranged any credit facility or injected any capital to maintain the $1 net asset value. And State Street had refused to extend additional overdraft privileges to the fund. The parent company Reserve did not have adequate capital to buy the Lehman assets at par. The Bents were unable to inject any of their own personal funds, contrary to representations they had made the day before. At 3:45 p.m., I assume Eastern Standard Time, Bent II told the board that he had called the New York Fed for assistance in meeting shareholder redemptions, but had been turned down, and that the total redemption requests were now at $40 billion. With no buyers for the fund's Lehman securities, the board had no choice but to vote to reduce their value to zero. For the first time in 40 years, the buck was officially broken. The company issued a terse press release. The value of the debt securities issued by Lehman Brothers Holdings, face value $785 million, and held by the primary fund, has been valued at zero, effective as of 8 p.m. New York time today. As a result, the NAV of the primary fund, effective as of 4 p.m., is 97 cents a share. Of the many possible consequences of a Lehman failure, no one seems to have thought about the collapse of a money market fund. It was a development that was unanticipated, a Fed official said. The SEC eventually charged the Bents and the Reserve Management Company with civil fraud for allegedly making false and misleading statements about the fund's financial state. The Bents countered that they didn't profit themselves and were simply trying to save the fund and protect themselves. They moved to dismiss the suit, which is pending. Ooh, let's look at this. Let's look where this is now. Let's see. There it is. Hmm. So we have a screenshot of the lawsuit here, but what happened here? So this is the lawsuit, right? In May. So then, oh, here the decision. Oh, never mind. Yeah, this is not. We need to see what the decision is. SEC civil fraud case, Reserve Management Company. Oh, they were. Oh, here it is. Here it is. They were cleared of charges. Here they are. They were cleared of charges. Okay, yeah. So it looks like the SEC didn't win the case against them. Okay, I see. All right. I'm gonna write this down later. Cleared in 2012. Late in the afternoon, William Studd and other AIG executives and their lawyers and advisors gathered in a conference room outside William Studd's office to examine the terms of the proposed loan that had just arrived from the Fed. After reading them, Richard Beatty, a partner at the law firm Simpson, Thatcher, and Bartlett, representing AIG's board, turned to William Studd. "You're now working for the federal government," he said. "They own you now." The terms gave the government a 79.9% stake and saddled AIG with an onerous interest rate of 11.5%. Again, if the taxpayers are going to foot the bill for you, you better pay them back, right? That's basically what the 11.5% is. William Stead's assistant interrupted to say that the Secretary of the Treasury and the President of the New York Fed were on the line. William Stead and Beatty stepped outside to take the call. "This is the only offer," Geithner said. "There's no negotiation." Paulson jumped in. "There's one more condition, Bob. You're going to be replaced." After Wilmstead hung up, he returned to the conference room. "Dick was wrong," he said. "I'm not working for the federal government." So basically, they decide to save AIG. At 6 p.m., most of the House and Senate leadership, summoned on short notice, gathered in Senate Majority Leader Harry Reid's conference room for a briefing by Paulson and Bernanke. Paulson announced that the Fed had decided to loan AIG $85 billion and essentially seize control of the company under the Fed's emergency powers. Bernanke pointed out that AIG stock was one of the 10 most widely held in 401k retirement accounts. Reid put his hands on his face, or put his hands in his face, put his face in his hands, same thing. "I hope you understand this does not constitute formal approval by Congress to take action," he said. "Do you have $85 billion?" Representative Barney Frank asked. "I have $800 billion," Bernanke said, referring to the Fed's balance sheet. Senator Christopher Dodd twice asked how the Fed had the authority to lend to and take control of an insurance company. Bernanke argued that the Fed had emergency powers to aid any company as long as there was a systemic risk, and gave a brief tutorial on a little-known section of the Fed's authorizing statute. Bernanke said that even this step might not be enough. Legislation authorizing additional aid probably would be needed as well. So this is just the first step, right? Let's look at the Federal Reserve. Let's look at their emergency powers. I want to see these emergency powers. About the Fed. I think you got to look at the Federal Reserve Act. And then right here. Let's see. Emergency. Let's see. It's got to be. It's got to be. There's only one emergency I saw. Let's see.
It's more within. It's more its member banks, right? I don't know. Where would where? It doesn't say where. I wish this article talked about what section of the Federal Reserve Act. Section 20. This is repealed. Huh, this is related to the gold standard. Of course, we're not on the gold standard anymore. Let's see. Receipt. Maybe this one? No. Maybe this one. Maybe this one. Maybe number 13. I guess there's a way to look this up. Which Federal Reserve Act did Bernanke invoke to save AIG? Let's see. Let's see if we can find. We're gonna get to the bottom of this. I want to know emergency powers, right? Doesn't say. I don't care about the why, right? I want to see the how. Oh, here. Here it is. This is the press release. Okay. Section 13.3. Did I find it? Oh, I found it, dude. Oh, I was right. Whoa. Okay, not bad, huh? I did find the correct section. Whoa. Okay. I'm really proud of myself. Wow. I'm gonna gloat about this for a little bit. I'm gonna take a little break. I can't believe I found the right section. Wow. Did I see? I think I need to go to law school, man. That was like, you'd hire a lawyer to do that, man. So let me write that down. It was 13.3. There it is. Wow, I'm really proud of myself. I'm so proud of myself. Wow. I'll be right back, guys. Guys, I'm back. I was so proud of myself. I went to tell my roommate what happened. For those of you who are tuning in, what's going on is this is one of the best readings on the financial crisis that is still shaping our world, right? A lot of wealth transfer happened. The middle class got destroyed, basically. Many millennials are never going to own a house ever. So it's been more than 10 years, right? And knowing what I know now, I wanted to read this again. So I told myself I'm going to finish this today because I've already done 2 videos on this. Owe it to myself, owe it to everyone to finish this. Why I was gloating was, so where we just left off, AIG, big insurance company, right? Have their hands in many, many jars. What we learned is AIG had customers all around the world. AIG had, let's see. So 74 million customers total, and 30 million of them were in the US, which means 44 million were outside the US. So AIG is a very big company, right? A very big company. So Bernanke and Paulson realized that if AIG failed, probably the entire world would be plunged into a depression. So they had to use something in the law or interpret, or some could argue BS something in the law to justify lending AIG $85 million. Billion, holy I said million, 85 billion, right? And it was 85 billion with a government stake of 79.9%. So basically the government now took over AIG with an interest rate of 11.5% for the repayment. So basically, to Bernanke and Paulson's credit, they were saying if the taxpayers are going to foot the bill of 85 billion, you better pay the taxpayers back, right? And I believe by 2015, I think it was paid back. So this was a good move by the Federal Reserve. Now, again, that's subjective, right? Because what is the definition of good, right? Just preventing this from failing. But obviously, we all know a lot of the execs, right? They got their bonuses, and it didn't punish bad behavior. But anyways, so that's why I was gloating. I'm like, I found the part of the Federal Reserve Act where Bernanke, this was the press release, right? Where Bernanke used to justify giving 85 billion to AIG right here. So see, it's a 24-month term. You see, 79.9% equity interest in AIG. So, and then, so this is the law, right? Section 13(3), right here. So discounts for individuals. So powers of the Federal Reserve banks, right? Discounts for, let's see, in unusual and exigent circumstances, the Board of Governors of the Federal Reserve System, by the affirmative vote of not less than 5 members, may authorize any Federal Reserve Bank during such periods as the said board may determine at rates established in accordance with the provisions of Section 14, Subdivision D of this Act, to discount for any participant in any program or facility with broad-based eligibility. It's so much legalese, man. But basically, look, individuals, partnerships, and corporations, right? So it could help out anyone in the economy, for lack of a better word. And so that's what I found, and I was really happy. I'm like, look at this. I found this. Let's see. Yeah, again, you got to celebrate your wins, right? I'm savoring the fact that I found something cool. You can also direct obligations. Yeah, anyways, there we go. All right, cool. So, celebrating that I unlocked my lawyer brain. Okay, so we are now back to 2008. This is
September 17th, Wednesday, Asian and European stock markets had dropped sharply and trading was halted in Russia. News that the primary fund had broken the buck had called into question the safety and viability of the global money market industry. The rescue of AIG gave the U.S. government not only 79.9% of the AIG's equity, but also priority over AIG's bondholders, which wouldn't be paid until the government was reimbursed. A number of money market funds owned securities issued by AIG. Already, money market redemption requests were surging. On Tuesday alone, there had been 33.8 billion compared to the total of 4.9 billion for the entire previous week. Large money market funds, including Fidelity, Vanguard, and Dreyfus, rushed to issue statements reassuring investors that their holdings were safe and would retain their $1 per share value. But that didn't seem to stem the tide. Even more worrisome, funds that had no exposure to troubled securities were confronting huge redemptions. Putnam announced that it would close and liquidate the $12.3 billion institutional prime money market fund, even though the fund owned no Lehman or AIG securities and maintained its $1 share value. Shareholders didn't lose any money. In the face of mounting redemptions, money market funds raced to sell whatever they could find buyers for. But there were no buyers for all but the safest, shortest term securities. Early that morning, Paulson had a disturbing phone conversation with Jeffrey Immelt, the chief executive of General Electric. Immelt reported that the capital markets were very bad, and Paulson said he understood that the commercial paper markets were under stress. That's bad for GE, Immelt replied. Like most large corporations, GE uses the commercial paper market to fund its day-to-day operations, including those of GE Capital, its huge finance arm. GE was worried about its ability to roll over its short-term debt, and the previous day had paid 3.5%, much higher than the normal for an overnight loan. The lower-rated Ford Motor Credit reportedly had to pay 7.5%. For companies like GE, the uncertainty was as debilitating as the high rates. The Treasury officials described the situation. Lehman Brothers begat the reserve collapse, which begat the money market run, so the money market funds wouldn't buy commercial paper. The commercial paper market was on the brink of destruction. At this point, the banking system stops functioning. You're pulling $4 trillion, guys, out of the private sector. Money market funds and giving it to the government in the form of T-bills. That was commercial paper funding GE, Citigroup, FedEx, all the commercial paper issuers. This was systemic risk. Suddenly you have a global bank holiday. Wow. Dang. Sometimes you need numbers to understand this. $4 trillion at risk, man. Wow. How much was the US GDP in 2000? 2008. How much was it? Let's see. Oh, that's growth rate. Sorry. I'm just trying to find. Oh, there. Here we go. Let me show you what I'm looking at. So, GDP in the US. Let's see. So it's around 14 trillion? Around 15 trillion. So 14.7. Let's do some math real quickly. What's 4 divided by 14.7? 4 divided by 14.7. 27.2%. Man, wow. 27.2% of the U.S. economy. Wow. Okay.
Actually, it would be even more important. Like, this doesn't actually, what I just found doesn't actually show anything, right? Again, you know that GDP is calculated by C plus G plus I um, plus X minus M. So what you would need to do is you would have to look at what percent of I, right? Because this is all I investment, right? So let's see. US GDP in 2008, broken down into its components. This would help a lot. I guess yeah, it would be here. We got to know what the I is. Thank you for not being. Oh, here. So that's disposable income. Whatever. We tried. There's got to be a place where it lists this, right? I just want to see what like the C plus the. Whatever. Okay. So, anyways, horrific as GE's situation threatened to become, Paulson had more immediate problems. Overnight, the cost of buying default protection against Morgan Stanley, Goldman Sachs had soared. Short sellers began targeting Morgan Stanley stock, which infuriated John Mack, who called on SEC to restrict such speculation. There was a danger of collapse in confidence in both Goldman and Morgan Stanley, as had happened with Lehman. After Lehman's bankruptcy, regulators froze the assets of Lehman Brothers in Europe, which included many hedge funds. I got panic phone calls from hedge funds, the Treasury official says. They couldn't get their securities. That was not supposed to be the deal. So people started running on Morgan Stanley and Goldman Sachs. The fire line broke. Woo! Paulson obtained from a Treasury lawyer a waiver of conflict of interest restrictions on conversations about government assistance for Goldman. The lawyer ruled that the magnitude of the government's interests outweighed any ethics concerns. Over the next few days, the Times has reported, Paulson's calendar indicated that he spoke to Lloyd Blankfein, Goldman CEO, more than 20 times, and to Morgan Stanley's John Mack a dozen times. Paulson's office, which overlooked the White House, was jammed with Treasury officials for an emergency meeting at 8 a.m. Bernanke, Kevin Warsh, and other Fed staff members were on the phone, as was Geithner, along with his staff in New York. Paulson had been up most of the night watching overseas markets. We're at the precipice, Paulson told the group. Nothing is breaking our way. We can't solve the problems of today. We need to think of tomorrow. We need to get ahead of this. It's deepening, moving too quickly. This is the financial equivalent of war, and we're going to need wartime powers. Bernanke and Geithner agreed. Paulson divided the group into teams. The government needs money, and it needs authority, Paulson said. If you had a blank sheet of paper, tell me what you need. That day, as investors rushed to the safety of short-term U.S. Treasury bonds, yields on 3-month Treasury notes dipped below zero. We watched the market for T-bills very closely, Donald Cohn, the Fed's vice chairman, calls. You knew there was complete panic and it was spreading. Wow, U.S. Treasury bills, bonds tend to be very safe. At the White House, calls were pouring in from throughout the financial world. Even strangers were cold calling me, Keith Hennessy recalls. They were all saying, we see the beginnings of a run on the financial system. The money market, the money funds were experiencing a run. People were literally pulling their money out and putting it in a mattress. Treasury rates were negative. People were locking in a loss just to protect their money. Geithner said, it's hard to describe how bad it was and how bad it felt. He got a call from a titan of a financial system who said he was worried he was doing
who said he was worried but was doing fine. His voice was quavering. After hanging up, Geithner immediately called the man back. Don't call anyone else, Geithner says. If anyone hears your voice, you'll scare the shit out of them. Wow. For those of you who are adults in 2027, 2028, I'm sure you guys have stories of how bad it got, right? How panicked everyone was. Wow. This is crazy. This puts a lot of things into perspective. Wow. Let me get some water. I'll be right back. Okay, so technically this is wine for cooking, but I'm having so much fun. All right. So the day's turmoil was reflected in the U.S. markets. The Dow Jones average dropped 449 points. It had fallen 7% in just 3 days of trading and was 23% below its level the previous year, which made it a bear market. Morgan Stanley shares fell 24% and Goldman Sachs dropped nearly 14%. The CNBC began running Morgan Stanley and Goldman stock quotes at the top of the screen in what some called a death watch. Washington Mutual dropped 13% and Wachovia fell 21%. It was chaotic, Blank Fine recalls of the rumors about Goldman's survival. There were people taking deep breaths, including me from time to time. He worried that a collapse in confidence, even if unjustified, would become a self-fulfilling prophecy. And Morgan Stanley, it was worse. The hedge funds panicked. A Morgan Stanley executive recalls, and by Wednesday, things had reached a fever pitch. Everyone said what the fuck am I reading? Everyone said the investment banking model was dead. I mean, yeah, it was always BS. Longtime friends and clients of John Mack called him to say that they were sorry, but they had to withdraw their Morgan Stanley funds. Do what you have to do, he told them. That afternoon, Mack issued a memo to his employees. It's very clear to me we're in the midst of a market controlled by fear and rumors, and short sellers are driving our stock down. Geithner and Paulson told Mack that he had to follow the lead of Merrill Lynch and find a partner. Since the collapse of Bear Stearns in March, Geithner had periodically suggested that the remaining investment banks become bank holding companies, gaining access to the Fed's discount window and other credit facilities in return for accepting regulations by the Fed. Morgan Stanley and Goldman Sachs had talked about it to their boards, but nothing had happened. A faster way to the same end would be for investment banks to merge with commercial banks. Here it comes. Back then, can you believe before 2008, they were separate. Investment banks and commercial banks were separate. Although the big commercial banks with their large depositor bases were still viewed as reliable sources of liquidity, Mack considered their balance sheets to be more precarious than his own. And indeed, Wachovia had to be saved in a matter of weeks, and Citigroup eventually had to be rescued. Still, Mac did speak to Vikram Pandit of Citigroup about a possible merger, but they jointly concluded that it made no sense. Geithner suggested that Goldman's Blankfein call Pandit. Blankfein made the call thinking that he was supposed to rescue Citi. He was dumbfounded when he discovered that Pandit wasn't expecting to hear from him. For his part, Pandit was taken aback that Goldman thought it might be able to buy Citi, since at the time Pandit felt that Citi was much stronger. That afternoon, Mac, speaking to Blankfein, bemoaned the effect of short sellers whose actions were unnerving in investors. The previous weekend at the Fed, Mac had complained about the impact of short sellers on Lehman and asked Blankfein if he would support an effort to get the SEC to ban short selling. Blankfein had demurred, but now he said, "We've rethought the need for a temporary ban." They agreed to press the issue with Paulson and Geithner. At 6 that evening, Bernanke met with his top aides, Donald Cohn, Kevin Walsh, Scott Alvarez, the general counsel, and Michelle Smith, the spokesperson, with Paulson and Geithner participating by speakerphone. "We cannot do this anymore," he said. "We have to go to Congress and get some authority." Paulson hadn't yet taken any concrete steps to enlist legislators to authorize a government rescue. Paulson reiterated his concern about getting congressional leaders to go along. "I spoke to Harry Reid and Nancy Pelosi, the House Speaker, and the political advisors," he said. "If the Treasury and the Fed say it's an emergency and we needed help, and help doesn't come, it would further destabilize the markets. You don't go public until you're reasonably certain you'll get what you're asking for." Bernanke was growing agitated. "Hank, listen to me," he interrupted. "We are done." It was the first time Fed officials had heard Bernanke raise his voice. "The Fed is already doing all that it can with the powers we have," Bernanke continued. One participant recalled, "Ben gave an impassioned, linear, rigorous argument explaining the limits of our authority and the history of financial crises in the U.S. and abroad. That history showed that efforts to resolve such crises are successful only when overwhelming force from all parts of the government is brought to bear," the participant said. It was an encyclopedic tour de force. It was as though Bernanke were the professor and Paulson the student. Bernanke's comments lasted about 15 minutes, and Paulson was uncharacteristically silent until the end. "Gotta go," he said, and hung up. So this was Wednesday, September 17th, 2008. It's only going to go downhill from here. I think we're going to finish this, man. Here we go. Eat some potato fries. What I love about this article, when I read it in 2009, was how it just very, very, it felt like you were in the room with them, right? And this is how it feels again to read this again after all these years. It felt like you're in the room with them. Okay. Thursday, September 8th. You can sort it out later. The Fed group reconvened at 6:30 that morning. They had decided the night before that repetition would be helpful. So Bernanke started on the same lecture. 30 seconds into it, Paulson interrupted. Ben. Bernanke stopped talking. "I've done some thinking," Paulson said. "You and I should go to see the president and then go to Congress and I ask for more authority." At 10:15 a.m., President Bush delivered a 2-minute televised statement outside the Oval Office, his first public pronouncement since the crisis began, which concluded, Our financial markets continue to deal with serious challenges. As our recent actions demonstrate, my administration is focused on meeting these challenges. The American people can be sure we will continue to act to strengthen and stabilize our financial markets and improve investor confidence." When staffers again huddled in Paulson's office, Paulson wanted to know what ideas they had come up with. Asian and European markets were continuing to plunge, with banks and insurers bearing the brunt of the losses. Britain announced a month-long ban on short selling in an effort to prevent the kind of bear raids that some blamed for the fall in Lehman stock. Russia had suspended trading for the previous 2 days. Morgan Stanley shares had plunged 24% the previous day. Paulson had just heard that Bank of America was temporarily pulling back on credit lines to some McDonald's franchises. Wow. Slowing a McDonald's expansion into upscale coffee drinks to compete with Starbucks. Wow. Bank of America disputes this account, but McDonald's did issue a memo urging franchises to find other sources of credit, according to Bloomberg. That's crazy. Even McDonald's was affected. Wow. Dan Jester, a Goldman vice president whom Paulson had brought to the Treasury. Oh, I'm missing a page. Oh no, I'm missing a page. Oh no, I stapled it wrong. Huh. I keep stapling things wrong. In my other article, I read the other time, I also stapled wrong. I gotta. Man, so funny. So glad I'm reading this. Can't believe I'm stapling wrong. Let's see. All right, so let's. Here, right? Yeah, there we go. There we go. All right. Reported that one approach would be for the government to inject capital directly into financial institutions. The standard way to raise capital is to sell stock. There were now no private buyers, but as one participant put it, was the government going to AIG them? If the government bought common stock, it would have the power to vote, appoint management and the board of directors, and if the stake was big enough, control the company. Might this end up being nationalization? The politics looked awful. Even so, Jester and most of his team argued that the approach was simple, efficient, and effective, and would protect taxpayers. Bernanke had long been saying that the government needed many tools to respond to the unforeseeable, including the ability to buy bad companies as well as bad assets. But Paulson told Bernanke he feared that direct investments would destabilize markets and drive out private investors. Another option was to remove the bad assets from balance sheets. The Resolution Trust Corporation, created by Congress in 1989, had used taxpayer money to buy and then auction off distressed real estate from failing savings and loans. There's some people criticize the agency for dumping assets on the market too quickly and selling at fire sale prices. The approach established a floor for real estate prices. This approach not only had worked in the past, but would avoid the charged issue of government ownership. Several people, however, noted that there were major differences between tangible real estate and esoteric mortgage-backed securities. Sorry guys, I'm just getting my pages confused. Where are we? Mortgage-backed securities. Oh, here. Houses and land could be auctioned and find buyers as they had been for centuries, but without any functioning market for mortgage-backed debt, how would you value it, and what would the government pay? If the amount was too small, bank balance sheets would be devastated by the sales and subsequent write-downs, making the crisis worse. If too big, it was simply a transfer of wealth from taxpayers to banks and other financial institutions. Yeah, I mean, that's what happened. Neil Kashkari, an assistant treasury secretary and an ex-Goldman investment banker who was the biggest proponent of removing bad assets from bank balance sheets, argued that the mechanics could always be worked out once Congress had given the Treasury and the Fed the authority to act. Stephen Shafran and others who had focused on liquidity issues proposed allowing money market funds to borrow from the Fed using their commercial paper and other assets as collateral. But Paulson thought this was too technical for the average money market fund investor and wouldn't be enough to stop a run. What would you do if you want to address all the issues? We could always just guarantee the money market funds, Shafran said. Paulson looked up. Could we? I think so, Shafran said. Paulson slammed his head down on his desk. Then that's what we're going to do. A few participants were aghast. The risks seemed enormous. It was a $4 trillion guarantee. Even the FDIC insured bank accounts only up to $100,000. Moreover, money market funds weren't bank deposits, but investment products with high risk and therefore higher returns. By eliminating that risk, another cornerstone of moral hazard was being removed. But others argued that the risk of not doing anything or of doing too little was far worse. Paulson embraced the boldness and simplicity of the notion. As someone said it, passed the USA Today test. I don't know what that means. But yeah. Yeah, I think I'm gonna call it. It's getting too hot in my room, so I don't want to be sweating and reading this. But obviously, you can see that the side effect of saving this too big to fail was to credit and wealth transfer. So sad. I don't know. Let me read your comments real quick if there's any comments. If not, I think we're gonna just call this because it's too hot in my room right now. As you can tell, the sun's bearing down on me. But maybe I'll do a final part, man. We'll finish this. Got through a lot of this, man. I'm really happy. But yeah, wealth transfer. Wealth transfer, bro. Can't believe it. Yeah. Yeah. A little disappointed, man. A little disappointed. And weren't there any other solutions, I guess, is the question that maybe that's for us to do other research. But at least this article made it look like there weren't any other solutions. So, anyways, did enough reading today. Did enough learning today. I also, by the way, I was studying chess earlier today, so I'm a little bit more tired. You could tell I kept stumbling on my words. So, anyways, guys, I think this is a good stopping point, and